not a reasonable amount of medication. With that said, for those of you that I'm yet to meet, we'll try that one more time. By way of introduction, my name is Michael. I'm from the Department of Finance here at Deakin University. If you'd like to find me, I'm based predominantly out of the corporate centre, though my office technically is in building LB 4228. So please feel free to pop in and say hello if you would like to have a conversation at any point in time in the future. I'm sure that there'll be opportunity to do that, and there'll certainly potentially be need to do that when you guys are applying for jobs and internships and that kind of thing. So again, feel free, those of you that are looking for gainful employment locally, please pop in, say hello, and we can have a chat about how things are progressing. Just a few housekeeping matters at the outset. I've got a couple of very talented former students that are coming in this morning. They're going to be doing some segments over the course of this seminar. They're going to be talking to you guys briefly about the global financial crisis and also superannuation in a broad sense. So that'll happen after the break. So I'll provide you guys with some introductions to them. I strongly encourage you guys to sort of reach out, those of you that are new to the program, particularly those of you that are somewhat aspirational, looking for top-tier jobs in banking or investment services. Both of them have sort of professed an intention to complete CFA and so forth. So if you're interested in CFA in particular, I think it's worth making the acquaintance and just sort of saying hello and trying to sort of think about those sorts of things, having those sorts of dialogues. Okay, a few other general housekeeping matters before we kick off. I'm going to be giving you guys your assignment this evening, so please jump online onto Cloud Deakin and download that. It'll be available around 7 this evening. You'll be able to download and peruse it. I'll provide you just with a quick summary of what you're going to be doing. It's not a terribly involved assignment in many respects, but it'll be somewhat different to what many of you have done in the past, because the onus will be somewhat on you to come up with topics and structures and so forth and actually respond to the assignment in a fairly unique way. So the assignment involves you nominating a financial topic, okay, and then going about responding to that topic. There'll be a standard rubric that will focus its attention, its orientation on how you go about framing your topic and structuring your response. I'm going to provide you with about 40 suggested topics. Okay, the idea is that everyone completes something unique. Okay, every assignment should be different. This isn't one of those exercises and everyone gets the same thing and we all submit somewhat similar versions of the same thing. Everyone's work will be different, and the idea is that you can focus your attention on something that's of interest. And again, the goal is that hopefully it'll inspire you to pursue something in that sphere. Try to nominate something that you actually have a genuine interest or passion for. Again, the reality is that it'll be far easier for me to just give you a very simple quant assignment and say, go away and hand it back to me. The goal of this assignment is really that you enrich yourselves, that you take something away from it. So please feel free to maintain a dialogue with me about your thoughts and ideas, what you would like to nominate as a topic. I know that people do get a little bit nervous about this idea of coming up with a topic themselves. Rest assured, it's a good thing. In the real world, no one comes up with ideas for you. All right, so the idea is that have a look at that summary set that I provide you, unpack it a little bit, think about what you're passionate about, maybe take one of the ideas as presented and vary it somewhat. So obviously in recent times, a lot of students are focused on contemporary issues. I can recall that Calvin and Rahul from memory worked on cryptographic currency or something from, yeah. And so there are lots of things that are happening at present that warrant your attention. New equity crowdfunding models, cryptographic currency, alternative ICO offerings, policies in relation to unicorn entities, the nature and structure of modern unicorn enterprises, so high value private enterprise. Beyond that, there are a huge number of interesting opportunities in fintech, decentralized lending, decentralized financial services provision, alternative ways to acquire financial services, the gamification of aspects of banking and finance, alternative credit scoring methodologies, financial inclusion through alternative instrument issuance. The idea is that you look beyond textbooks. What I want to really sort of emphasize is that most modern textbooks are based on a narrative that was framed over 173 years ago. If you look at the first modern textbooks, okay, first truly modern textbooks probably written in 1912 to 1915. Okay, they haven't changed much in that time, but finance has. All right, and so the goal of this this seminar. The goal of this entire course, in truth, is to make you aware of that. And finance is actually changing quite markedly at present. I know that people often talk about, seminal change within industries. Well, it's actually happening now. We're seeing decentralized lenders. I've seen a huge number of ICOs achieve remarkable success in recent times. 10 years ago, if you were to do this course, none of these things would have mattered because these things didn't exist. But they are relevant to all of you guys. There may well come a point in time that you guys want to pursue one of these opportunities in a commercial way. This is an opportunity to actually test ideas, okay, to actually formulate viable ideas and to test them, okay? I have several students that have come out of my program and are now part of the Deakin Startup program that are funded through Deakin Ventures now. All right, one of them is actually working on a crowdfunding real estate platform in India, okay, that's doing well, and another is working on a distributed real estate services platform also in India. So again, you can take an idea and you can actually make it a reality if you're genuinely keen to do so. Those students were sitting in this same lecture theatre, actually, the class used to be just over there, so in the lecture theatre just over there, all of 1 year ago, okay? So the reality is, morning guys, find a seat, all good. Reality is you can do that too. Okay, so in terms of the specifics of the assignment, you are graduate students, but I do appreciate this is probably your first assignment, okay? And I get the lovely opportunity of sort of introducing you to how we do things a little bit differently within, to an extent, I'll describe them as Australian models of education, but in truth, they're probably true mechanisms for assessment in all Anglo-American models of education. All right, there's a strong emphasis on you. There's not as strong an emphasis on the exemplar standing in front of you. The idea is that you formulate ideas and to an extent come up with a formal narrative around them. All right, there's no standard answer. There's no standardization in terms of response. Two people can provide a very similar set of commentaries on the same issue, but equally they can provide a very divergent set of commentaries on the same issue, all right? So just be mindful of that when completing the assessment. Equally, there is not going to be an archetype response in mind that we have when we're marking them, all right? So please bear that in mind. Any number of different responses will be viable. Beyond that, it's important to appreciate that we really emphasize not using rote approaches. Okay, so not just regurgitating the material that you find in textbooks or other sources. The idea is that you actually frame part of that dialogue and that part of that narrative. But equally, there is an expectation that you will use viable resources to support or substantiate or offer a counterpoint to the claims that you're making. All right, so I'd encourage you to use platforms like EBSCOhost, EconLit, all of which you have free access to formulate your response. The assignment is made up of 4,000 words. We don't include tables, we don't include footnotes and addendums and appendices. So if you want to add some additional extraneous material, you can do so at the end, all right? If you happen to go over the word count a little bit, I don't mind. I'm not going to be counting your words, all right? As much as I would love to have the time to say that I would do that, I'm not going to, all right? So please bear that in mind. You don't need to apply for any exemption if you're between 10 or 15% over the word count. So what does that mean? 4,000 to 4,500 words is fine, okay? How many of you have, I'm guessing no one has done this because no one does this during O Week, but how many of you guys went to the library session on research during O Week? Really? That's fantastic. One is like fantastic. That's a huge number. All right, you guys never did, didn't you? That's all right. I appreciate your honesty. Look, the session is actually worthwhile if you've never used research databases before. We have a huge number of them here. The one thing that I do appreciate is having taught across South Asia and Southeast Asia is research can be done a little bit differently. Here we do expect you to use persuasive resources. So publications from top tier journals like Elsevier, Taylor and Francis, sourcing them through EBSCOhost, again, is the approach that's sort of expected. Some of the questions that have a more quantitative element might involve slightly different approaches. If, for argument's sake, you're doing some sort of comparative analysis, it may well be the case that there aren't a huge number of third-party citations that you can use. Okay, so it's very much case by case. Some of you are going to come over and have a conversation with me at the midpoint to ask me questions along the lines of how many citations should I have? How long is a piece of string? It's entirely up to you equally. And look, another popular question is, what structure should I take? Again, entirely up to you. I'm more than happy to sort of furnish some examples, but it's very open to interpretation. It's entirely in your court. Okay? It seems really, really onerous now, but by the time you get to MAF 759, MAF 760, and those sorts of units, when you do similar assignments, at that stage you'll find this to be a remarkably straightforward and potentially enjoyable exercise. That's really the goal. Okay? All right, and obviously, if you have any concerns, if there's any consternation or worry, if you've never done this before, I'm only an email or a phone call away. Okay? A couple of other general housekeeping matters. I will provide my sincerest apologies for the slight delay. I've been making a few updates to your material, but you will have a summary of your readings and your outline this evening also, just to review. Okay, so you'll be able to read ahead for those of you that are rather eager, because you'll have all the course material to do so. Okay? Just bear with me as I make some updates. All right. So, with that said, I'm going to kick off, and shortly after the break, we're going to go over a couple of key topic discussions that are going to be led by Calvin and Rahul around the global financial crisis and around some critical issues relating to superannuation. Okay, so please be mindful of that. It's often the case that we do examine those areas of competence, so please pay particular attention. I'm sure any materials that Calvin and Rahul have, we can furnish to you afterward. Okay? All right, so let's make a start. So today we're talking about banks and commercial banks. It's a fairly light topic in many respects because there's a lot of theory. All right, so first half is banks and commercial banks. My apologies, banks and commercial banking, and the broader narrative will relate to NBFIs. So in the first half, our orientation is very much on how banks function, and in the second half, we look at the broader set of financial institutions that make up the financial system. So not wanting to insult anyone's intelligence, I'm sure you guys are fairly familiar with what banks do, so I'm just going to go into some of the more nuanced aspects of modern banking. All right, so we're going to evaluate the functions and activities of commercial banks, identify the main sources and uses of funds, outline the nature and importance of off-balance sheet business. And I cannot emphasize this enough. Off-balance sheet business is critical to modern banking. In fact, it's perhaps more critical than traditional on-balance sheet activity. All right, off-balance sheet activity represents about 9 times the value of on-balance sheet activity. So on every occasion that you review a bank's financials, you come to discover, by virtue of the size of any given bank, they do a lot. Just try to appreciate that there's 9 times that level of activity happening beyond what's represented on the balance sheet. Okay? We're then going to spend some time talking about risk exposure and some of the broad risks relating to banking. And that serves as a really worthwhile segue into Rahul's discussion of the global financial crisis. All right, so what are the main activities of a modern bank? I'm guessing for many of you, this is why you're in a program like this to work with a traditional bank or an investment bank. It's worthwhile to appreciate what they do. The vast majority of what a bank does is rather, in my view, disinteresting. It's a lot of traditional financial intermediation. But for some, that can be a source of great enjoyment. I dare say it is an important and critical provision, because in the absence of banks, most people wouldn't be able to pursue home ownership. I think one of the first major interactions any of us has with a bank is in respect of a loan provision. And again, worthwhile segue into our subsequent discussion of the GFC. All right, so within the Australian model of banking, we have 3 categories of bank. We have incorporated banks, unincorporated banks, and we have foreign representative offices. So to put it in perspective, a HSBC is a local incorporated bank. They're actually fully incorporated locally, okay? As are our major banks, the ANZ, the NAB, Westpac, and CBA. Okay, they are our major banks. Effectively, our banking sector is an oligopoly. What do I mean when I make reference to the term oligopoly? Think back to your economics days. What is an oligopoly? Yep. I wouldn't go so far. I mean, cartel is an extreme economic collaboration. So a cartel is a formal, coordinated activity by a group to generate profit. So one of the true modern cartels, one of the few cartels is what? Calvin? OPEC, that's exactly right. So OPEC is a cartel, all right? But the reality is the vast majority of associations are not true cartels. Our banking sector is an oligopoly. What is an oligopoly? Yeah, well, they effectively do operate in a monopoly-like way, which means they tend to, people aren't going to like me saying this, but they tend to underprovide in terms of service level, and they tend to generate what we describe as an economic rent, a monopoly rent. Okay? That means that they're earning more than a break-even amount. Okay, they're generating an actual economic rent. Okay. Is that a bad thing? Well, some would argue no. Shareholders in those companies would certainly be quite happy with that. But the reality is our sector is not terribly competitive. Okay? In India, you have, what, 20 banks that are of comparable size, that are significant, and you have state-level variation. Here we have none. Okay? Our banking sector probably more closely resembles the banking sectors of Belgium or Germany or Japan. But even they, in truth, are somewhat more diverse than ours. In Japan and Germany, the major banks own substantial amounts of equity. Deutsche and Allianz Drenzer are two of the largest equity holders in the world. Our banking laws are such that it never evolved that way here. Okay? So our banks are quite different in that regard. And I'll speak more to that issue in a moment. But why is it that banks are so important? Why do we spend so much time on them? Okay, prior to my involvement in this course, we spent a full week on banks and a full week on non-banks, and then another substantial amount of time, full week potentially, on just super and mortgage securities. Okay, we don't need to spend that much time on those things. They're fairly simple, but my point is, why is that much emphasis placed on these issues within most of these courses? Why are banks so important? Sorry? Banks are important in terms of managing our finances, but the reality is, yep. Okay, so the representation was made, without banks, the economy wouldn't work. So prior to the 16th centuries, banks weren't terribly active, but economies functioned. It was much more difficult, wasn't it? There was far more emphasis placed on barter and exchange, and coinage was generally backed by the few banks that were in existence. Governments didn't issue central currency. The reality is, we talk about banks so much because they control the vast majority of financial assets. Plain and simple. All right? Their service functions could be performed by a number of different categories of enterprise, but they control just so many assets. We're talking in this country about several $1 trillion worth of assets. Okay? It's very hard to fathom that amount of money. I struggle when trying to espouse what a trillion is. It's a very crude concept in a lot of ways, isn't it? But look, I like this analogy, and I think that a lot of speechwriters spend a lot of time framing this one, so I'm going to steal it from Ronald Reagan. And essentially, a trillion, as described in an economic circumstance to a general population, was described in the following way. Essentially, if you were to stack $1 bills, one on top of the other, okay, $1 trillion is the amount of notes that you would require to be able to reach the moon. Okay? It's a very, very substantial amount of money. All right. So they control the lion's share of financial sector assets. Okay? The next largest segment is the managed fund super fund segment. Okay? In this country, we have a substantial managed funds industry, a super fund industry, and that's because we have mandated superannuation. As I mentioned, week one, the fourth largest wealth endowment of its kind anywhere in the world. And that's why you should be seeking out opportunities in this category. There is more wealth in that wealth endowment here than there is in China and India. Okay? So the Chinese pension fund industry and Indian pension fund industry collectively would be of comparable size. Okay? Because neither of those countries has a mandated superannuation program. All right? The Chinese managed fund industry is now larger, without a doubt. The managed wealth industry in China is huge. But in terms of mandated superannuation and pension schemes, there are very few schemes anywhere in the world that are remotely comparable in size. presents a huge number of wealth management opportunities. All right. So a couple of key thought points to sort of frame our thinking around this issue. The banking sector has changed markedly in recent years. We've moved from an asset management approach to a liability management approach in banking. And this has been driven in part by technology and the talented professionals that have shifted mindsets within the banking sector. So what is an asset-driven approach? Well, there used to be an old adage in banking. Banking was about 2, 2, and 2. Okay? Lending at 2%, getting out of the office at 2%, and being on course by 2 o'clock. All right? So again, it's a joke. The notion was that people would all be essentially doing the same thing in banking, and the goal would be to get your work done so you can go out and play around, all right, on course before the end of the day. Obviously, there was far more complexity to it than that, but the reality was, in the absence of modern computing technologies, banking was much, much harder. And there wasn't much variety in terms of service offering and service provision. The vast majority of banks did do the same sorts of things. With the advent and availability of technology and very talented operators, we've seen a shift in banking to a liability-driven approach. Banks take far more risks now. They engage in dynamic transactions that involve a lot of complexity, a lot of transactional partners. Some lending activities involving major banks and investment banks can involve as many as 300 consortium partner members. So banking is far more dynamic than it once was. What else is of particular importance? Well, we now have dynamic secondary markets that allow people to raise money in quite a straightforward manner using very popular securities. As I mentioned, the bill market has been around for some time, and it continues to be a very popular and important market. You might note from last week when we talked about the earliest financial institutions, the earliest joint stock companies, and we talked about the Dutch East India Trading Company being the first joint stock company. We talked about the emergence of formal currency and banked bills during the Venetian period, the mercantilist period in Venice. But the reality is, bills, as I mentioned, during that session have been around much longer than that. The first early bills were probably issued in the 12th century in China. Okay, and modern bills are just a modern take on that historic instrument. Modern bills are usually issued through some sort of set of securities legislations. More often than not, there is one piece of securities legislation that is common across currencies and countries, and that's the bill legislation. You'll find that almost every country in the world has laws in relation to the issuance of bills, a Bills of Exchange Act. Our Bills of Exchange Act is a very, very old piece of legislation. It's one of our oldest pieces of legislation. You'll find in other countries, their Bills of Exchange legislation precedes the 17th century. Okay, these instruments have been around a really long time. They continue to be very, very important. I really can't emphasize that enough. Why am I emphasizing this? Because most people that do these courses only think about equity. Australians only talk about equity for the most part. The reality is there is a very dynamic and important secondary market for debt instruments as well. The bill market is an important one. It's one that you should consider in terms of the career opportunities that it presents. All right, so the Bills of Exchange Act governs the issuance of bills in this country. There are a number of different bills you're going to learn about in this course. We need to do that in about 3 weeks' time. Okay, it is an important discussion. All right, we're going to skirt over the other financial services discussion for a moment because that will come through in the ensuing discussion. We're going to focus our attention on that off-balance sheet business point. Banks have really taken the view in recent years in particular that it makes sense to carry more contingent risk. It makes less sense to carry more direct risk. What do I mean when I say that? Well, modern banking is demarcated, or I should maybe use a more positive word, defined by the use of off-balance sheet business. The notion here is that a bank would rather engage in a transactional activity that doesn't involve the creation of a balance sheet liability. They would much rather serve as an underwriter. They would much rather serve as a guarantor. They would much rather provide you with high-cost lending products that you aren't going to ordinarily use, like credit cards. All of these transactional types are examples of off-balance sheet business. The bank isn't actually carrying a formal on-balance sheet liability. It's just carrying a contingent liability. Okay? More on that in a moment. So how do banks actually procure funding? Well, this is of particular importance. Banks are the only institutions, generally speaking, in most jurisdictions that are allowed to accept deposits from the general public. So it's a regulated term in most countries. In Australia, in India, in Sri Lanka, in China, many systems of law that are strongly influenced by Anglo-American systems of law, the term itself is protected. You can't call yourself a bank unless, of course, you're given the lawful right to do so through the securities legislation. So in Australia, to call yourself a financial services provider that is a bank, you need to actually secure a banking license. And we don't just give them out to everybody. Okay? We don't just issue them willy-nilly. But the truth of the matter is, in recent years, there have been more issuances. A number of non-traditional lenders are now trying to become banks. That's happened a lot in recent decades. And there seems to be a renewed trend towards that. So how do banks secure funds? Well, through loans and deposits from the general public, and through the issuance of share capital. Our banks in this country rank amongst the largest in all of Asia. In fact, our 4 major banks were all in the top 8 as recently as 7 years ago. Okay? They're now only in the top 15 because major banks in China and India are growing really, really quickly. Okay? And they're allowed to consolidate. In China and India, laws around consolidation have been quite different to the laws that have evolved here. We in Australia have a law known as the 4 Pillars Policy. Okay, Rahul will know this. What's the 4 Pillars Policy, Rahul? Yeah, you do. He's just being polite. All right. The 4 Pillars Policy is a law that precludes our major banks from merging. Okay. Our major banks are not allowed to merge because we don't believe it to be a viable outcome in terms of competition, so we don't allow them to do that. But the reality is it means they can't compete at scale with the banks of Asia. All right, so while our banks at a point in history were actually approaching HSBC in terms of regional dominance, they're certainly not on the radar in terms of the top 5 any longer. Okay? All right. So what types of products and services do banks offer? Well, the vast majority of what we consider to be traditional banking relates to traditional lending, the provision of a mortgage. You go to a bank because you want to buy a house. In this country, housing is expensive. Right? Does anyone follow our market? Okay. Little known fact, our property market as a whole, the residential property market, trades at the highest income to property multiple of any market in the world. Any market in the world. Okay? There are some parts of certain markets around the world that certainly do come close, and on occasion will evidence higher multiples. But our market overall operates at the highest multiple. There is more mortgage stress in Australia than there is in any other OECD country. So that means people are putting into their home loan more money, relatively speaking, than any other OECD country in the world. Okay? So something that gives you a little bit of perspective. We're going to talk about property crises in a moment, of course, but it serves as interesting food for thought. So, beyond loans, what do banks do? Where does the innovation come from? Well, banks do a number of innovative things. Our investment banks in particular have been very innovative. So Macquarie Bank was the first issuer of warrants, vanilla warrants in the world. Vanilla warrants are options attaching to debt tranches. What else do banks do? Well, banks, as I mentioned, they issue bills, they issue certificates of deposit, they engage in a lot of transactional support, so they provide guarantor services, they provide underwriting services, they provide other simpler credit products like credit cards. They even engage in securitization processes. So sometimes banks will pool the relatively differentiated mortgage assets, property-related assets that they have into vehicles. When it works particularly well, they can get relatively homogeneous or consistent assets and create standardized products. Okay, so they can actually take all of their mortgages, pool them into different vehicles, and issue instruments against them. That process is known as securitization. And it's a very, very popular activity for banks, albeit one that is less popular in Australia than in many other countries around the world. In the US, it's a very, very popular activity, buying a securitized asset. All right, but I'll leave that to Rahul. He will be the exemplar in that regard. All right, so a couple of categories of deposits: current deposits and call or demand deposits. The reality was there was a point in history where there was literally no competition within banking for these categories of product. But people are now looking beyond current deposits and call or demand deposits to slightly more higher yielding products like trusts. So Macquarie Bank's cash management trust is a very, very popular alternative to a current deposit or a call or demand deposit. But these categories of deposits still rank as the most popular. Why do you think that is? Any thoughts? Yep. That's exactly right. That's what it comes down to, that brand strength. And that's really, let's be frank, that's all the banks have left. It's kind of funny saying that at present because of the current Senate estimates inquiry that's going on into banking. But the reality is many of us still really value those brands. I've been a CBA customer since my childhood, since they came to my local public school with a little collection system. They gave us little paper boxes that we could put money into to save towards a bank account. I mean, that's really what banks maintain, brand strength, the perception of security, because the vast majority of non-bank financial alternatives to current and call deposits are vastly superior in terms of yield, aren't they? What kind of yields are on offer within these instruments? Sorry? You're getting 2% really? On your current deposit?
Yeah, because students...
Yeah, 2%. 1.5%.
1.5% is good. What are most people getting?
Less than 1.
Yeah, most people are getting 25 basis points. 25 basis points is a quarter of 1%. You should be banking wherever they're banking. All right? Most people are getting 25 basis points, which means they're actually losing money. Why are they actually losing money? That's exactly right. That's exactly right. The rate of inflation is actually exceeding the yield on their current account. So please bear that in mind when thinking about where you put your money. But there are trade-offs. You get transactional benefits. Let's be clear. You know, if it's a transactional account with a low holding level, then there is a strong incentive to maintain that account because of the transactional benefit. All right, what about term deposits? This is where it gets interesting. We are currently experiencing a market like very few before. I'm not going to say none before because it's the naivety of every generation to assume things haven't happened before. But there have been very few occasions in history where we've seen yields at such historic lows. Why are they so low at present? Why are they so low? Yep.
As I'm sure the GFC and tried to lift interest rates in order to
keep them down. Yep.
give the big capital a bit more money.
A boost, that's exactly right.
It hasn't worked, so they drop the interest rates to keep the economy.
Exactly right. So for those playing at home, the response was that in essence, in a post-GFC world, rates have been kept down to stimulate the economy. Okay? And so at present, people around the world are actively chasing yield, and there are so few good yield opportunities, but there's so much capital to be thrown around that needs to go somewhere. So there's a huge amount of capital in North America, in Japan, and in China that needs to go places. But the yields within those contexts are so low. We in Australia are experiencing those too. How low are rates at present here? What is the current rate? Excellent point. It does depend on what I'm talking about. So offer me some examples. What are some of the rates that we could conceivably be talking about? What is the interbank overnight rate, cash rate? What, for argument's sake, is the entry-level depository rate offered by the majors at present on a 6-month, 12-month? Sorry? 5%. Where are you getting 5%, my friend? You'll have some investors soon. There'll be people playing at home. Don't want that. 5% you've got to work for right now. 5% is effort. Yep.
My home loan's 4%.
That's fantastic for a home loan. That's pretty good for a home loan.
Yeah. But on my overdraft, they charge you. It's a bit high, and it's common bank.
Yeah. It's the reality is the majors are obviously going to charge more because of their brand strength and so forth. But at present, we're talking about outrageously low rates of interest. We've observed interest rates that have been between 2.5 and 3.5% for the better part of this decade, haven't we? That's very, very, very low. At present, you're talking about cash rates that are well and truly, or have been well and truly, sub 3% for the entire post-GFC interval. Okay? So they're very, very, very low. Okay? This causes people to engage in a different approach when it comes to investment. They engage in far more risky behaviours, and they actively pursue yield opportunities because those yields are so low. There was a point in Australian history where rates were approaching, we're getting at the poor end of approaching 20%. I mean, that was the history that many people in this country have endured. So you can see that Australia's had a really interesting history when it comes to rate positions. And as a consequence, the term deposit offerings that are provided by banks have varied markedly too. So the current offerings are not really that enticing and not really that exciting. People are not really finding them to be terribly appealing. And it's caused people to pursue opportunities within other markets more. Our property markets have seen a deluge of funds. Our equity markets continue to be incredibly popular because people are not going for these risk-free options as much, relatively speaking, even in a post-GFC world. All right. Here are some instruments that are worth noting, albeit briefly. Banks use negotiable certificates of deposit to manage their balance sheet. All right, they issue these instruments, papers issued in their own name, issued at a discount against face value. These are bill-like instruments that banks issue in their own name to manage their balance sheet position. We don't spend too much time on them in this course because, in truth, if you can price a bill, you can price a negotiable CD. The same thing for all intents and purposes. Okay? This is the source of a reasonable amount of our focus when it comes to the relevant week. Bills of exchange. Bills of exchange are not dissimilar to certificates of deposit. The key point of difference is they're more marketable, generally speaking, because of the manner with which they're issued and the deep and liquid secondary market for bill issuance, bill instruments issued through bill issuance facilities. All right. I'm not going to go into the specifics of it because that would take a fair bit of time, and we're going to do that in a couple of weeks. Okay, medium to long-term debt instruments, debentures and unsecured notes. Just be careful with this terminology because the term debenture has a new technical definition. Its definition has evolved through time. It's one of those situations that we converge towards a common definition. In this country, a debenture historically was a bond supported by a form security being a charge over assets, and an unsecured note had no such supporting security. If you go online, you'll find both definitions for a debenture. Okay? So in this course, we made very, very clear we're making reference to an unsecured note or a note with security. We don't really use the term debenture too often, just because of the confusion that it causes. I'm just drawing your attention to this issue now. All right, foreign currency liabilities. Debt instruments issued into international capital markets that are denominated in a foreign currency. As I mentioned, there is a lot of capital around. Banks around the world are trying to take advantage of that, so they'll issue instruments into multiple markets. And there's obvious diversification benefit that attaches to doing this as well. Okay? All right, and finally, loan, capital, and shareholder equity. Quite logically, you would think that a bank would want to minimise the amount of shareholder capital that it issues, but by law, banks are required to issue a certain amount of equity, and they're required to maintain a certain amount of capital to risk-weighted assets. Okay, around the world we've seen convergent legislation. In the post-Asian financial crisis world, this was the first set of laws that was enacted. Okay? Those laws, what are they referred to as? Anyone? That's exactly right. That's exactly right. The Basel Accord, okay, named after the location where the laws themselves were formulated. We've now gone through multiple cycles of revisions to the Accord. So we've seen Basel II and Basel III. We're already at Basel III stage, and Basel IV is being formulated. Okay? You are going to be examined on aspects of that, but we're going to get to that in due course. All right, how do banks utilise funds? Well, banks use funds in a number of interesting ways for personal and household finance, for commercial lending, and lending to government, of course. We in this course devote a fair bit of attention to simple loan products, so we look at amortising and non-amortising loans. Okay, they're the two primary products that we focus on in this course. So we're going to be learning about how to price a term loan, how to determine the instalment payments that attach to a multi-year amortising term loan. Okay, so in this market in Australia, the vast majority of lending happens where sufficient traditional capital is provided to support the loan. What do I mean when I say that? Well, loans traditionally in this country were generally well capitalised. They were supported by very sound deposit amounts and by sound underlying assets. The reality is we are seeing a shift in mindset occurring, albeit it hasn't translated fully to the values that we're observing in the market, but more and more people are borrowing without the provision of the traditional 30% capital minimum assigned amount. What do I mean when I say that? Well, traditionally within our market, it was very, very hard to secure a loan without providing 30% upfront in relation to that loan. So you could secure 70% of an asset's value if you provided 30%. And that threshold was around 30% traditionally because that was where mortgage insurance kicked in. Okay? We're now seeing more and more borrowers borrowing with substantially less than 30%. And this is something that happened in North America. In North America, the low doc segment, what might be described as the low FICO score segment, was around 20%. All right? In Australia, the low doc or low capital segment is generally no more than 7%. So it's still a much smaller segment here, but it's interesting that things are moving in that direction. And why are they moving in that direction? Well, houses are just getting really expensive. Now, it's just a simple numbers game. We're getting to a point at which income is struggling to service the property multiple level. Yep.
I think also the foreign investors, with their capital, are pushing up the prices, which local people can't always do.
Look, there are some theories around about the interest of foreigners in domestic assets, but the reality is that the interest has generally only been focused to a handful of areas. It's certainly not been across the board. You know, you're not finding a huge amount of foreign interest in a huge number of assets in the western and northern suburbs, outside of entry-level property that everyone buys at a similar price point. I think there might be a little bit of a media sort of beat up when it comes to that issue specifically, but yeah, certainly some foreign interest has played a part. But, so certainly in some of the eastern suburbs locales, you're probably right. There is probably an element of that, but that's when you think about it, we're talking about maybe 5 to 7 suburbs, out of, hundreds, so overall, in terms of the overall complexion of the market, I would say negative gearing has a far greater role to play. Anyone know about our negative gearing laws? What can you do in Australia that you can do in very few countries around the world? Okay, I'll ask you this. In India, are you allowed to buy an investment property and then claim deductions against that property against your personal income? Yeah, to what extent though? Yeah, not like here. Look, there are some limited offset rules in places like India, places like Singapore, but in Australia, people can quite comfortably go out and buy an investment asset and they can use depreciation against that asset and costs against that asset to reduce their tax liability. So there's a strong incentive for people to buy a second and third property, to generate sufficient offsets to reduce their primary income. So undeniably, one of the key drivers of price increases would have to be this law. I mean, I think people debate it quite fervently because there's a very politically significant climate that sort of underlies this debate. But the reality is the basic numbers, I mean, just make sense. If you've got more people that are more incentivized to invest in property, more people are going to invest in property. And if you took the law away that would encourage those people to invest in property, then they wouldn't invest in property. So I don't know how it becomes a debate, but people somehow manage to make a debate along the lines of, well, it's important to provide mum and dad investors with mechanisms through which they can invest and generate additional generational wealth. But when you're talking about multi-million-dollar assets, the divergence that it creates is pretty substantial. Anyway, that's a discussion for another day. All right. Some of the commercial lending activities of banks relate to fixed-term lending to business. Obviously, businesses borrow. One of the easiest ways to do so is with a major bank. How you can borrow, how much you can borrow is going to be a function of your capital and your credit scores. All right, some very popular mechanisms include overdrafts, bank bills held, and leasing when it comes to bank service provision. So what is an overdraft? It's the ability to draw an account down beyond the zero balance. Many businesses like this facility. Bank bills held. Banks actually acquire the bills of other institutions because of the yield benefit that comes from them. And finally, leasing, very popular activity for modern banks. Okay. Banks also acquire a substantial number of Treasury-issued instruments. So in Australia, our short-term discount securities issued by the Commonwealth are referred to as T-notes. Okay, you might have heard of the term T-bill before, because people often use the North American expression. Okay, this is just our version of the T-bill. In Australia, we've not issued substantial tranches of T-notes. Okay, we generally only issue them if there is going to be some sort of substantial discrepancy or difference between tax receipting and payments that need to be made in the short term. And because Australia's tax model is generally one that's reasonably predictable, there's not been too much need for it. We do continue to issue them generally for another very obvious reason. Why do we generally issue $5 billion worth every couple of years? Why do we do that? Why do we always issue an instrument even if there's no real need to do so? Yep.
To contain the rate of inflation, keep the rate of money.
It's much simpler than that. Much simpler than that on this occasion. No, well, we do, for all intents and purposes on occasion, use them that way. Sorry? Again, yeah, very, very good reason to be doing it. We issue them just to ensure that there's continuity in the market. So even if there was no need to do so, we'd still issue some. Because you need to provide the instrument to the market to ensure that there is some interest or knowledge of the instrument. So the reality is we'll issue some, even if we don't need to, just because we want to maintain the market. Okay? The vast majority of tranches that have been issued for that reason, just to maintain the market. Treasury bonds are our medium to long-term security. Banks will acquire these for a number of reasons. They count in the context of the Basel Accord provisions as being, beneficial. They can also be included in repurchase agreements, which means they're very, very flexible instruments. They can be carried to generate yield. They can be very quickly returned to government to provide liquidity. All right, very, very flexible in that sense. All right. I'm now going to talk briefly about off-balance sheet business and why it's so important. Off-balance sheet business is of particular importance because, as we've discussed, the mindset within banks has shifted markedly towards trying to carry less risk and trying to carry more contingent claims or contingent liabilities. Okay? So what do I mean when I say that? Well, a contingent claim is a liability, but it's contingent upon a particular circumstance occurring. Okay? These sorts of liabilities, generally speaking, differ markedly from traditional bank-carried assets. When you provide someone with a loan, you're essentially extending finance to them. If they default, you lose those funds. If you provide someone with a guarantor agreement, or for argument's sake, a documentary letter of credit, a standby letter of credit, you're only supporting their transaction. They're paying you a fee, and if they default, if they don't make good on that transaction, that's the only time you will be called upon to get involved. Okay, standby letter of credit, you only get involved if something goes wrong, but you still generate earnings from the transaction. All right, if you loan directly, that money is locked away. It can't be used for any other purpose. If you support a transaction by providing a standby letter of credit, your money isn't locked away. Your money is only going to be utilised in the event of that contingency. Okay? So, key expression to remember, off-balance sheet business relates to the contingent claims and contingent liabilities of the bank. Right? These are the categories of instrument. The first couple are harder to remember than the last couple. We'll go through them fairly quickly. A direct credit substitute is, in essence, as the name would suggest, a substitute for direct credit. I can either provide the customer with direct credit or a substitute for direct credit. And so the best example is a standby letter of credit. Okay? Let's say, for argument's sake, I am an Australian firm and I want to pay a Chinese manufacturer, but they're unfamiliar with me and who I am. All right, they might, for argument's sake, want some evidence of my capacity to pay. All right? I might approach my bank and say, well, on this occasion, I could use your assistance by requesting that the bank provides a standby letter of credit. The bank agrees to do so. The bank doesn't give me a cent, but I still pay them a fee. Okay? And in the event that I don't pay, they will have to make good. But more often than not, I will make good on the transaction. They don't need to do anything. Okay? So the bank is acting as a guarantor on behalf of the client for a fee. Okay? The term guarantor is perhaps an imperfect word, but I think it's the best word that we have to explain this kind of structure. All right, what about category 2, trade and performance related items? Well, on this occasion, I am seeking support for a non-monetary completion or outcome. Okay? I like to use construction-related examples. Think, for argument's sake, about the provision of a property contract. Let's say, for argument's sake, I want some buildings constructed. Okay? Deakin is doing this quite frequently. We will use third-party builders to complete a construction program. How can we ensure that the builders make good, actually complete on time and in time? Well, we might request they provide us with a performance guarantee. Okay? In the event they don't meet the construction schedule deadline, they are required to pay financial compensation. So how can we confirm or be somewhat confident in the fact that they're going to do that? Well, we might request that they approach their bank to provide a performance guarantee in documentary form. A performance guarantee asserts that the bank will pay us compensation in the event that they don't complete. Okay? So that is a trade and performance related contract. All right, this is the one that everyone will remember. It's a formal commitment provided by the bank. What is a good example of a formal commitment provided by the bank to do something? Underwriting, the share tranche. People are issuing shares into the markets. There are many IPOs at present. How can all of these IPOs provide a surety to current shareholders and their team that are going to raise the monies that they need to raise? Well, the only way they can do that is by seeking the services of an underwriter. The underwriter agrees to acquire any unacquired securities for a fixed fee and most likely a discount as well. Okay? So that's an example of a commitment that a bank can make. Another really obvious example is a credit card. Okay, how many of you guys have a credit card? Everyone has credit cards, right? They're wonderful things, aren't they? There's free money that comes through credit cards. Wonderful. All right. Credit cards are actually really, really expensive commitments that banks make. Normally they come with introductory rates of between 0 and 5%, particularly on balance transfers, and you're transferring quantum of money from one card to another. More often than not, they have ratchet clauses in them that involve the rate shifting to 15 to 22% shortly thereafter, after the initial phase. To provide that commitment, the bank is obviously requesting the fee. How will the bank know whether you're going to use the funds or not? In truth, it won't. Okay? And many people maintain very low credit card balances. That doesn't mean they don't pay fees. All right, so it's a great way for the bank to generate fee income. All right, finally, off-balance sheet and other. This is the all-encompassing category that catches all other contingent claims and contingent liabilities. So think, for argument's sake, about futures, options, foreign currency denominated contracts, currency swaps, and forward rate agreements. All of these instruments give rise to contingent claims. We do not know what the bank's formal liability is because most of these instruments haven't reached their appropriate settlement date yet. Only then will we know. So all we can do is estimate a balance sheet equivalent and account for it that way. Okay? So much of this, the majority of it, in fact, is accounted for in full off balance sheet. All right. So it's well over 6 times. It's probably closer to 9 now in terms of the multiple value. All right, I'm just going to get through these last few so we can have a break, and then you guys can hear from Rahul and Calvin. All right, when it comes to prudential supervision and regulation, what do you guys need to be aware of? Well, we have a key prudential regulator. They are APRA. APRA ensures the capital adequacy of banks. It ensures that banks are maintaining sufficient capital against risk-weighted assets. One of my first jobs at PricewaterhouseCoopers was checking all of the capital adequacy calculations of banks. It was a really fun job, as you can imagine. Yeah, really got me excited every day. Sort of wake up and do that. But I can speak with some confidence about the importance of this. In the absence of good capital standards and maintaining good capital standards, things can go wrong very, very quickly. All right? So ensuring sufficient capital ensures that in the event that there is a major call on the bank's funds, the bank has funding sufficiency. It ensures that in the event of any sort of economic challenge, the bank has a liquidity buffer and a capital buffer that is of sufficiency. APRA is the one tasked with this duty, okay? So they ensure the prudential adequacy of banks and a number of nominated NBFIs. The other key regulators beyond APRA in the context of the banking system are the Reserve Bank. So they maintain the payment system and they ensure system stability. We're not going to dwell on them too much because we devote a full week to monetary policy in this course. And ASIC, the Australian Securities and Investment Commission. If you start a new enterprise, you will do so through ASIC. Finally, we have the Australian Competition and Consumer Commission, the ACCC, and they review competition policy and trade practices, and they implement the 4 pillars policy as well, or when I say implement, they review all transactions relating to the 4 pillars policy, which precludes our major banks from merging. Okay, so these are the key system regulators. Please take note of them, in particular the role of APRA. Probably worth noting that obviously the CBA has been in the news in recent times because one of their depository systems wasn't compliant with money laundering legislation, anti-money laundering legislation, I should say, not money laundering legislation. What was the compliance issue? Does anyone know? What were they not doing? They got one of the largest fines in corporate history. But I did a calculation. Technically, they should have got around you think about the incidents and the value of penalty per incident. What was it, around 50,000 incidents at $100,000 per penalty? They got off very, very lightly in the end. They only got a $500 million fine. I think it's substantially more than that. The non-compliance issue was that they weren't tracking cash deposits made overnight to the depositor directly. Okay, major compliance issue. But again, an easy mistake to make. You wouldn't want to be the guy that missed that, though. I don't think he's getting his bonus this year. Just quietly, I think he's going to miss out on that. All right, so background to capital adequacy. The laws were enacted through Basel I, 1988, post AFC, and Basel II, remarkably, was in 2008. Why didn't Basel II happen in 2008? Again, interesting timing. All right, so we tend to be quite reactionary when it comes to creating these laws. We had major financial crises, and post each crisis we said, well, let's do things differently. And so what are the major changes that came out of Basel I and Basel II? Basel I was a very simple framework that involved credit scoring and capital assignment into only a handful of categories. It only involved in about 43% revision to transactions at a transaction level. So that means the vast majority of transactions weren't actually revised as a result of changes implemented by Basel I, but it was still a very important starting point. It got people thinking about how they should be scoring things. But then we got to the GFC and we said, all right, let's look at this again. It didn't work perfectly the first time, and we created more complex categories and more categories for assignment and higher capital threshold expectations. We said you need to be holding more capital and higher quality capital as well. They were the major changes that were implemented. All right, we're going to do a stack of questions relating to this next week. So, Basel II. It extended upon Basel I to add different sensitivity criteria to Basel I. And the main elements included more complex credit risk analysis, the use of a standardized credit scoring methodology, an internal ratings-based approach, or an external ratings-based approach. What's kind of remarkable about what Basel II enacted was that technically it gave the banks a lot of power around how they could go about enacting a model to manage compliance. The reality is the vast majority of banks just chose to do whatever their key regulator said. Rather than offer up an alternative model, over 90% of the models that were presented were based on regulator methodology. Okay, so no one tried to vet their own methodology. Things may well change in the future with Basel III and Basel IV actively encouraging enterprises and banks that are engaged in financial services provision to take a more considered approach to the way in which they go about scoring their risk-weighted assets. All right, so this is the requirement for Basel II. In a couple of weeks when we do credit rating methodology, we're going to go through Basel III and Basel IV as well. But at this point, this is the extent of what you need to know. All right, so under Basel II, the requirement was you maintain a minimum 8% capital against risk-weighted assets, of which 4% has to be Tier 1 and the remainder Tier 2. Many jurisdictions have chosen to require that their banks hold more. So in Malaysia and in India and in China, the banks hold more capital than the minimum level. Okay? In Australia, the vast majority of banks do as well, just because it makes sense to not be at that number. Even though it's the most profitable number to be at, no one's going to sit at that number. You'll find that there is some variation in the way that this information is presented, particularly when it comes to comparing banks in the UK and banks in Australia, which is a rather unfortunate aspect of the issues attaching to accountancy and different local approaches to the implementation of the accounting review of the Basel Accords. All right. So these are the categories of capital. Obviously, Tier 1 capital is the highest quality capital. Tier 2 capital is referred to as supplementary capital. I should mention, with Basel III and Basel IV, the Tier 2 definition has been made much more stringent, and the requirements in relation to Tier 1 capital have gone up. Okay? Why am I showing you Basel II? Well, this is the remarkable part. The vast majority of emerging world banks are only really at Basel II threshold Basel III. Okay? They're not at Basel III, Basel IV. In Australia, we're at Basel III, Basel IV. There is no hard and fast rule around the world that says anyone needs to be anywhere. So some countries will take longer than others to implement these changes. Okay? So in the vast majority of emerging nations, this is still standard practice, albeit they supplement this rule by requiring that banks hold more anyway. So in some respects, they're already meeting aspects of the new standard, just not meeting it in terms of the structure of the underlying capital. All right? The structure that they've chosen is a little bit different. These changes are going to be implemented within BRIC economies and within a number of emerging nations over the course of the next few years. So you are going to see these changes enacted towards Basel III, Basel IV. Look, I should consider that there are many, many banks in the emerging world that are at Basel III as well. There are. All right. Okay, so just a broad overview of what Basel Accords account for: credit risk, operational risk, and market risk. And in the context of credit risk, there can either be a standardised approach or an internal ratings-based approach. The vast majority of institutions have taken a standardised approach. Okay, we're talking about upwards of 80% of banks in most countries, and in Australia about 90% of banks. All right. I'm not going to dwell too much on this because we are going to talk more about it over the course of the coming weeks. But for all intents and purposes, the standardised approach just involves, very, very simple, it involves looking at the value of the balance sheet item, multiplying it by a risk loading factor, a risk weighting, and then multiplying it by your capital requirement. Let's say, for argument's sake, you have $1 million loan. It has a risk weighting of 1.5 or 150%. The calculation would be as simple as $1 million multiplied by 1.5 multiplied by 8% under Basel II. If it's a non-balance sheet item, if it's off balance sheet, then we have what is known as a balance sheet conversion factor. We use that balance sheet conversion factor to shift the asset from an off-balance sheet value to an on-balance sheet equivalent. But as you can see, it's a very basic set of calculations. All right, we're going to do some examples, perhaps later today, and certainly in the coming week. Okay. I'm not going to dwell too much on operational risk. We all understand operational risk. The Accords require that you actually assign capital to operational risk and that you acknowledge operational risk in your business process, quite logically. Market risk involves a slightly divergent approach being taken. Market risk involves the analysis of risk pertaining to those contracts that are moderated by market movement. We take a number of approaches to this. One of the things that we're going to be doing a little bit more of this year is value at risk. All right, so next week we'll be doing some value at risk calculations to account for market risk. All right, almost at an end. Okay, this is just for knowledge's sake. Please note the following pronouncements are the key APS rules in relation to liquidity management. This is one of the many fun jobs that I used to have, determining whether banks have implemented these rules correctly. Essentially, banks need to have both static and dynamic sources of additional liquidity. So what are some examples? Well, banks need to have arrangements in place to access dynamic liquidity from other institutions and other organisations and other banks, for argument's sake. Banks need to also have contingency plans in place to ensure that in the event that there is a major call on funds, they can make good. Banks should be able to account for intraday liquidity. So on a day-to-day basis and on an hour-to-hour basis, and indeed on a minute-to-minute basis, banks need to be able to confidently assert to the regulator that we have sufficient liquidity to meet the needs of all sector participants that we are engaged with at this very moment. If they don't, it's a big deal. People go to jail. Okay? This is not the kind of white-collar crime that people don't get in trouble for. All right? This is a really, really big deal. So people scrutinise this very, very closely. Why do you think this is scrutinised so closely? What would happen if there was a major run on one of our banks and they couldn't make good? Well, the reality is it can be quite devastating. If all of those funds are lost, how do people account for their situation? How can people make good on what they need to make good on? The reality is all of our banks are effectively in a tacit sense and also an active sense, underwritten by government. So major banks are not going to be allowed to fail. It doesn't mean they want to put themselves in a precarious situation anyway. You might think this stuff never happens. Does anyone follow the cricket? Okay. Anyone remember Alan Stanford? Really? What kind of cricket fans are you? Remember Stanford Millions, where England played the West Indies? The once-off tournament for $10 million? These Stanford Millions would have been 8 years ago? No, 9 years ago, 9 years ago. Yes. No? No one remembers that happening? Okay, well, Alan Stanford was a very, very wealthy individual that owned a number of banks in Bermuda, in Trinidad and Tobago, in the Bahamas, across the West Indies. He also had a number of operations around the world. His banks were seemingly reasonably well capitalized. It was discovered, however, that they weren't well capitalized and there was a run on one of his banks. It caused his entire banking model to collapse. Because banks aren't designed for every customer coming to the bank and drawing down money at the same time. They simply can't account for that. And when that happens, it doesn't matter how good the bank is, they're not going to have sufficient liquidity. Well, that happened to a number of his banks, and obviously they collapsed. And this is a good teachable moment for everyone. It's a good learning opportunity. It was discovered ex post that the banks were audited by how many people? Have a guess. It's one thing you should always be looking at when you're looking at investments. The banks were audited by one firm based out of the UK that had one partner and one staff member. Okay? So this is what was discovered after the fact, and everyone was like, oh, it's all making sense now. They missed a couple of things. So yeah, there was a bank run, a huge number of people lost huge amounts of money. Those models weren't tacitly and actively underwritten by the local governments, and consequently, there was a substantial economic impact on the region. All right, this is just generality that I've already talked about, so I think at this point we can give ourselves a 10-minute break. Please bear in mind, after the break, we are going to be going through a couple of discussions around key issues that are going to be considered in the context of your exam, so please pay particular attention. I shall see all of you guys back here in 10 minutes. All righty. After the break, you guys can do the rest of it. You have the USB?
No, I sent it on. He sent it on the email.
Okay.
On your email.
All right, no problem.
Yeah, send across the slides. Really nerve-wracking seeing so many people in there.
No, you'll be fine. You're a smart lad. Let's walk you both up. Don't worry. This is just it's on mute, so it's fine. Like I said, this is one of those. You know, this is like you're like JoJo Siwa. Do you know who she is? This is the launch vehicle. Just to make you guys showcase your talent. No, it's all good, guys. Yeah. All good.
So I just wanted you to have a look at it to see.
I did have a look. I read your notes. I just didn't get a chance to reply.
I've obviously thinned it down a little, and I had another like a couple of line about synthetics, but I didn't go into too much detail on how they are. So what they are. So I'm just going to say the insurances, and just explain the transaction really quickly.
Just both of them, or just yours?
Yeah, both of them are together.
Okay. So who's got yours and you first? So.
No, his first. But
Oh, you're going first, are you?
Yeah. Or do we just rework the
Well,
slides?
I haven't covered super yet.
You got to go first.
Is that okay?
oh, that's fine because
Yeah.
he's covering super very much.
So yeah,
It's his intro, anyways.
it is, isn't it? Look.
Do you
Oh
want
no,
me to go
no,
first
no, no, no,
before
no,
we-
what? No, it's fine. You guys do it that way.
Yeah.
Okay. What I might do then is just do 5 minutes to just talk about NBFIs and 5 minutes, and then you go talk about super, yeah?
What I
So they have a bit of context.
Oh, okay, sorry. I'm totally
It's okay.
Yeah, but so
Acronyms
this
are
is
annoying.
my.
Yep.
So just for the securitization part, I just added this thing for synthetics as
Very
well.
weird that you can't replicate the screen and not show
I'm
what's
not
going
going to
on.
go too detailed onto
What do you
this.
mean? You
but-
want to see your notes?
No, as in, you can just show like a screenshot, but not what's going on right now
Why?
on Windows 10.
Why?
What do you mean? You can.
Okay.
Yeah,
I don't know.
you can. Of course you can. You can freeze the projector.
Yeah, this is just the way that they've set it up. Of course you can.
Yeah.
You can there's multiple projector views, but at Deacon, for whatever reason, they never do presenter view. They never default to presenter view, but I can set it to presenter view if you want. No, I'm happy to.
No.
Did you put notes in?
I did. Well, top of my head. I never like putting notes because I always.
Don't. You know, this is the idea is just like I said, just talk to the issue in a broad sense. That's all. I'm sure they're going to get something out of it. The idea is just to try to get people to think about their careers from T1.
Justice.
Wait, Cameron, I sent a slide yesterday. You didn't put it in. Like, you didn't use the one I sent you? No, you did. You did. Good. You put it in. Okay, so with the
So when you guys each do yours, can you do like a clear introduction as to like what you're talking about?
Yeah.
Only because I'll take the little snippet out of your thing, and I'll put it up on the cloud separately too.
All right. Yeah, I'll give an introduction of mine because mine's directly linked to what you're saying before as well.
Yeah. Okay.
So yeah, I just wanted to have a look at my securitization thing.
Mm-hmm.
Is it too detailed or is it?
No, I think it's great. You just might need to, if you're going to use like a big word, just explain.
Yeah, I will. I'm not using too many big
No, it's fine if you do. Like people need to hear different things.
Yeah,
The only
normally.
way you become familiar
Yeah.
is by hearing something.
Yeah, so that's why I put
You guys sticking around afterward too, for a bit?
Yeah. Yeah.
Cool.
Stick it on.
No. After.
Yeah.
I wanted to really try to finalize your paper. I don't know if you spoke to.
Yeah, we had a problem with the stuff we're doing as well.
It's no biggie. I'll have a chance. Yeah. There's a few other ways that I might end up just doing it
You have
quickly and staying
MATLAB,
anyway.
but we just don't have the.
I can give you some custom code. That's fine. But MATLAB's less than ideal because like MATLAB's great for some aspects of simulation, but when you're doing simple things, it's like you can do it, but it's a lot of rigmarole through something simple.
Yeah.
Which is the only frustration with it. It's kind of like MATLAB's kind of like an empty room. It's great because you can end up making that room look however you want.
Yeah, but you don't want an empty type. All you're trying to do is color.
But if you're consistently doing something similar, like presenting to a group, well, it's nice to already have a chance. You know what I mean? So, but it's fine. We'll figure out something. But I don't know if he told you, but I have a couple of things that could be a good fit for you. So I'm working with a couple of organisations. I've obviously arranged the teaching, and they've been kind of pleasuring me at you guys with that. So I'm going to touch base with them this week. They've got a super high-quality place. You wouldn't be laughing at. Two other places that I'm doing some consulting with who potentially need people, which is good. So one of them is like chartered accountant, but for these students are local people. So they're launching in Singapore. So they're expanding their team in Singapore. Teams that run out of Melbourne.
Oh, yeah.
Yeah. So it's good. Like I said, it's accounting, but it's not. It's more a management thing. So yeah. So hopefully that's passing the next round.
Also, my economic side, the average thing is not working enough because they change the regulation. My strategy applicable like 2 years ago, but it's not valid anymore. Like, I just go to
There's plenty of stuff. And
So I think
what I was going to
accounting is
say
pretty much
is like,
what it is.
now that you guys have finished, you guys can both get on the system here.
Yeah.
So I'm going to send your CVs to Monica to get approved. But see, I did it with the structure in mind because now I'm going to be able to say that we did both of these things, which is mental health. That's getting your approvals. So they're going to, the classes are going to start very soon. So obviously 8 weeks time, there's a group of classes. The ones that I'm doing now, I'm going to see if you guys can get into 702. I haven't controlled 702. Sorry? That you can do that if you breaks.
Yeah, so can you do
The experience requirements of the issue.
Yeah,
Will be under the issue. If I can get out of it, my funding comes from, when I get out of it, that will only be
okay.
so I've become their grants are
Right.
there's also two
It seems like the other company as well.
there's two more commercial grants that are quite significant. We're getting confirmation on as well.
If for Michael's last one.
If any of them, then everything kind of comes up. Good thing is with some of my classes, I'm saying numbers, but I was going to say about the European marketing online.
Yeah,
That's fine.
that's amazing. Because my economics now are completely available now. So I would technically be looking at something either in accounting or finance. So I'm going to structure 2 resumes now. Like build one towards year 1, towards finance.
Well, like I said, I've got a couple of things I think we can do. If my funding actually needs someone to go wrong, something that's good, it's pretty good. But I'll probably be able to say I got someone. But yeah, just kind of keep yourself in a state of readiness.
Yeah, ready already. Ready for work.
Hopefully that's before October.
Sorry?
Hopefully that comes up before October.
Yeah, well, either way, you're going to be
Either way.
back after.
Yeah.
I'll be.
You won't leave immediately. It's not like you're going to leave immediately after October. You know what? I'm leaving already.
If you go full time,
That's
Yeah,
what
exactly.
if I get full time.
So, don't screw up.
do they have enough workload?
They do have it. They're planning to expand. I'm getting the feeling that the team's planning to expand.
They don't tend to take people on at that place until they need someone.
Yeah.
Yeah. Like, the team's not huge. They only take people on when they need them.
But if
noticed
they're expanding, that's what
So do you guys want to stand here? Well, if you go, yeah. It's up to, no, it's up to you. There's two. You guys gonna both? It's up to you.
You know, we don't take what this is.
No, it's okay. Because you handle lectures, so you know what needs to be done.
Alright, give him one more minute.
Hopefully it looks good.
Yeah.
Okay,
Who
and
do
so
you look at when you're presenting? Because this is way bigger.
that's fine. It's fine. Just stuff. I tend to look at everyone, smiling faces,
Yeah.
and just remember, like, I wouldn't let you do this if I didn't think that you could.
Right.
Please keep that in the back of your mind.
Yeah. But this is the
Okay,
biggest one
I've
spoken to.
taught 10,000 students across 7 universities. Right?
Alright.
How many people have I involved in this conference? My point is, I'm very capable. Just look at the smiling face. Anyone, look, I'm going to tell you something that just feels like sometimes South Asian people in particular will be inherently dismissive because you're a similar age to them. Alright, it's a cultural thing. They've come over to me afterwards and said, you know, I've had several that I've got to know that have been like, you know, literally come over and said, I thought you were some fancy person from UK trying to schools. Like, I literally had 2 students last week come to visit me and be like, you know, we're sorry if we were a bit quiet because there are cultural things that happen. Right? Who cares? Don't worry about it. You know what? Look at all the smiling faces. Don't look at the ones that look dismissive.
Yeah.
The ones that look dismissive are just resenting you because you're in a better situation than they're in. Okay?
Also because you're smiling it's early in the morning. Smiling right now.
Exactly. No. People are tired.
Yeah.
It's fine. we're not talking about, I don't know, Elon Musk's new investment or something. We're talking about super energies. There's only so much excitement that you can bring to those students. All right. So your goal is
to bring a little more excitement.
So I think that's the majority of that. So look, everyone's going to think that you're eminently capable. Take a second if you need it, anytime. You know, just pause. Pause for dramatic effect. Just pretend that you're pausing for dramatic effect. Just do that. All right. I'm just trying to set your mind at ease. It's all good. You know what's harder? I find it much harder talking to 5 people that I really care about something. Don't you think? This is easy. This is easy.
I find it easier
I find it easier.
they think the way I do, so it's easier to
Yeah,
not
that's
say
not
things.
always true. See, very few people think the way you do, Calvin.
All right. I'm just gonna kick off and go from there. Do you guys want this? I'm not sure if you. All right. I'm gonna stay near here then. All right, so going to make a start. So the second half of our discussion is orientated on NBFIs, okay? And in light of, I guess, the importance of a couple of categories of bank and NBFI, we're going to have some focused discussion on 2 key topics. You'll recall the reading for this week relates to the GFC and the banking sector generally. Rather than provide you with just a brief note, I've arranged for a couple of former candidates in the program who I'd consider to be exemplars from the program to come talk to you about each of these segments. So both Rahul and Calvin have been doing exceptionally well through the program and ex-post, and I believe have recently graduated. They've been actively involved in publishing and both have forthcoming publications in Tier B and Tier A level journals, which I think is exemplary and will garner them a lot of interest in the management consulting space, which is why I'm mentioning it. But beyond that, they've also been very, very active participants in programs and have gotten actively involved in a number of things that we've done on campus, including but not limited to clubs and society-related activity, as well as getting involved with things like the film initiative, that fusion film initiative that we did recently, as well as, I guess, getting involved in co-curricular activities. So both of them have been actively involved with a number of startups, from Learner Library to Hive Minds, and Calvin's been with Platinum Accounting, and my apologies, Rahul's been with Platinum Accounting, and Calvin is now with Deloitte Financial Services. So they've both made good on their time. So the reason that I'm mentioning this is because they were in the same situation as you all of a couple of years ago, and I think that they've made good on their time because they actively sought out opportunity at the very beginning, okay, from day one of year one. Beyond that, they've done so well in the program that they're also going to be actively involved in some teaching going forward within both undergraduate and graduate programs. So they're good people to connect with. I'd like you to sort of make the effort to sort of say hello if you do get the opportunity at the end of the session. Beyond, I guess, their work with Platinum Accounting and their work with a number of startups like Hive Minds and also Deloitte Financial Services, they also have a lot of acumen around what's worthwhile in terms of careers and charters. So those of you that are thinking about CFA in particular, if you're giving genuine thought to CFA, both of them are reading for CFA, okay? And there'll be good people to connect around if you want to sit the exams as well. All right, so we get a group of people together that want to do CFA with the view that hopefully you guys can all support each other. Okay, so if you'd like to read for CFA or any of the GARB certifications or any of the certifications from Bloomberg, I think that they'd be good people to talk to about that and where the value resides within those certifications. All right, so I'm now just going to give you a quick pressing on the second half of our discussion. In the second half, we're going to be talking about NBFIs. The vast majority of NBFIs in this category are remarkably straightforward. They operate in a very, very staid and ordinary way. We focus our attention on the insurance sector and how insurance-based organisations operate, how they source funds, how they utilise funds. We look at contractual savings institutions, in addition to looking at traditional insurance funds. We also spent some time talking about money market corporations. Money market corporations are essentially investment banks. In Australia, the technical term for an investment bank is a money market corporation. We then spent some time talking about unit trusts, REITs, and hedge funds. All right? Undeniably, in the context of this discussion and your careers, superannuation is arguably the most important of these categories of NBFI, just by virtue of the opportunity that's presented through superannuation. Calvin's working for Deloitte Financial Services, essentially working in the managed funds industry. The vast majority of you that are pursuing top-tier opportunities, I would encourage to pursue opportunities in this category because of the sheer volume of work that's available. In Australia, we have over $1.4 trillion in funds under management at present because of superannuation. That's more funds under management in pension funds in Australia, as I mentioned, than in India. Okay, a country with a vastly larger population. All right? It's one of the reasons that so many talented investment brokers and investment fund managers from North America and from India and from China have come to Australia because they want to pursue opportunities in this category. So with that said, Calvin is going to provide you guys with a précis on superannuation and how the super funds industry operates in a broad sense, and perhaps some of the work that he does within reason. We don't want him to share any proprietary knowledge and get himself fired. But within reason, some of the work of the organisations that he's been involved with in recent times as well. So if we could all come together and welcome Calvin. All right.
Right, so I'll start off with what superannuation is. Does anyone know what superannuation is? I didn't when I came here, honestly. So it's, to give you perspective of what it exactly is, it's like a 401k in the US or a pension fund in India. You invest in a super fund or a superannuation account to save for your retirement. You get access to it at 60 or it keeps going up every year according to regulation, but it's just there for you to have a retirement income or a lump sum at the end, which isn't taxable, but makes it really attractive. So it started off in 1992 with, I think, with 3.5% super guarantee. Super guarantee is what your employer has to pay. Now it's 9.5%, if I'm not wrong. But yeah, so it started off in 1992, and it was just there to supplement or replace dependence on age pension. Age pension being the government giving you money when you reach the age of retirement and you don't have enough to self-fund the living expenses. So this is just a means for you to have retirement income streams, and you can invest, or essentially depends on which super fund you go to. If you have a self-managed super fund, you do the investing. If you have an industry super fund, well, the big financial institution does it for you on your behalf. So that being said, the next slide. Purpose of the superannuation. Like I said, it's there to supplement your income when you retire. It's for you to accumulate wealth over time. So there are a few regulatory bodies that are responsible to ensure compliance of super funds, namely APRA, ASIC, the ATO, and I think the CIS Act, which is the Super Industries Supervision Act. It's just that to ensure that you get a tax offset whenever you do contribute into your super account. To get into technicalities, you have two contributions. One is concessional and the other is non-concessional. Concessional being you can claim a tax offset while you're filing your taxes, and non-concessional being it's non-concessional. So essentially, your employer has to pay 9.5% of your ordinary times earnings into your super account, and there is a tax benefit in doing so with you contributing a non-concessional, because you have, I think, a 15% taxable amount in your super account, whereas your highest marginal tax rate in Australia is 47%. Not ideal if you're looking at saving for your retirement. So the purpose of superannuation is to reduce, like I said, to reduce the liability on the government in terms of them spending for age pension. The graph on top shows how life expectancy has just been growing over the years. I think right now average life expectancy in Australia is 82, but you retire at 60, 62, which means for 20 years, if you don't work, you got to fund your living expenses from somewhere, and that's where it comes, superannuation. The table below just shows how the superannuation industry has been growing or forecasted to grow over the years. For now, I think it's $1.4 trillion, as Michael said, and it's just going to grow to 2.8 and then roughly $10 trillion by the end of 2040. So it's a big industry, and it's mainly growing because of the workforce in Australia, with the demographics changing and mandatory employer contributions that need to be paid in. Superannuation is just going to be bigger and bigger over the years. So there are types of super benefits. There are different super funds, but different types of benefits. You have essentially two, but there are three. Because you have an accumulation account, which is, again, it's how much you contribute into that account. That will determine how much you get at the end of it. It's sort of like an annuity when you calculate cash flows, equal cash flows into that account, and then it's compounded over the years, and you can either get a lump sum at the end, or again, you can draw down eventually over time. With a defined benefit, it depends on the multiple that you're using. It depends on the number of years that you've worked for a specific employer, your salary, your wages, all of that. So it's calculated based on a formula, and then you get a defined benefit as a multiple of your retirement salary. Example would be 65% of your final salary. So that's what you will get at the end of retiring, essentially. And a hybrid is a mixture of both, where you have part defined benefit and a part accumulation. So the last bit. Types, you have 5-6 types of super funds. The first one being retail super funds, which is like your BT, or you go to a Combank or any of your banks that provide super funds for you to invest in. With corporate or employer funds, your employer sets up a superannuation fund for you, and that's where your employer contributes their super guarantee. And the third one being industry super funds. Industry super funds were initially set up for people working in specific industries. Like if you work in hospitality, you usually were in Host Plus, but it's become a retail super fund over time because now anyone from anywhere can invest or buy into industry super funds. Self-managed super funds are are in a trend right now where a lot of Australian households are accumulating or amassing wealth over time, and they feel that they need to keep control of their investments. It recently, I think, grew to $880 billion, if I'm not wrong, with self-managed super funds. So it's pretty big because you can borrow and buy retail property or investment property through your self-managed super fund. But the caveat is you're responsible for all the compliance and tax filings and ensuring that your super fund is compliant. Because if it isn't, there's serious ramifications in terms of being non-compliant. Tax ramifications where it goes back from the time you've started your super fund until the present date that you become non-compliant. So there are various aspects in self-managed super funds, but there are advantages as well. Going on, there's a small APRA fund, which is regulated by APRA, and it essentially is sort of like the self-managed super fund, but the members of the fund will not be responsible for compliance of the fund because the trustee is appointed by APRA. Because your trustee is appointed by APRA, you don't have to maintain any of the compliance. The trustee takes care of everything. All that the members need to do is decide which investments the fund needs to go to and which investments they'd like or they're comfortable with. The last one being MySuper, introduced recently. Off the top of my head, I don't know when, but it's not ideal. But so the MySuper is a default super when an employee or a member doesn't select what type of super they're electing, investment style they're electing. You have 5 different styles of investments. The top one being growth, then there's moderate, then there's conservative, moderately conservative, and then there's just cash. And this is what a default is. Essentially, on MySuper, either invest your super money in a lifestyle or life cycle investment, depending on where you are in your life. Say if you're a 20-year-old, it goes into aggressive investments, and then when you're tapering off into retirement age, it goes to conservative cash and enhanced cash investments. So these are the type of super funds that are available in the market. Depends on your preference, whether you like control or whether you want to give the responsibility of control to someone else. Whether you have information to all financial securities, whether you know the regulation in superannuation or various aspects. With managed funds at DFS, we essentially try to manage clients' portfolios through looking at risk and return relationships. Not all returns are equal. There are industry super funds that today earn 13.6%, while your S&P 200 earns, I think, 8.8, 8.9% at best this year, trading 12 months. With that being said, if you look at it, it looks like the industry super fund is doing a lot better than the market. But there's the other aspect of them investing in high growth assets, really aggressive assets. Whereas an equally balanced portfolio that's the Morningstar index gets, I think, 9.5% a year. So anywhere when you're investing, you always look at risk and return relationships to gauge them in terms of how much risk you're taking versus how much return. That's essentially what happens at DFS. We have different asset classes that we invest in, and it's blended all together to get a target return or target volatility. That's essentially what we do. But the whole process is trying to establish that all returns, all good returns are not the same. If you get returns from enhanced cash, it might be 2-3%, but you might get returns from stocks, which might be 8%. The risks are completely different. It just depends on what type of risk you're willing to take and where you are at that moment. Because over the years, the studies have shown that yes, stock markets trend upwards. It's not necessarily true. We've had a lot of financial crisis, and by having a portfolio manager or portfolio solutions company, it helps keep track of where the financial market's heading and exactly how that risk needs to be managed. Because when you're 50 and you lose 60% of your portfolio, you can't do anything. If you have $1 million in your super account, 60% is wiped out because, say, the GFC happened, you have 400,000, it's not going to last you 20 years. So that's why you need a professional to explain and understand the risks in the market and where you are at your life. And that's where portfolio management company comes in for retirement planning. That's all I have to say. I'll give it over to Rahul. He's going to do the GFC, I think.
Great. Does anyone have any questions? Not at all? Maybe like how Cal has a job at Deloitte when he just graduated? That's a good question. What do you think? I want to ask that question. All right, other questions related to super? Like why you chose super? Why is it interested in the funds industry? What opportunities exist? Why, for argument's sake, this might be chosen over alternative, more popular careers like those in equities? I think everyone pursues opportunities in equities. Every second person wants to be an investment banker. Can't be that many. Recruit about 7 to 10 each year. All good questions. I can pretend to be a student and ask a question for everyone at home. That's no one has any questions.
Okay. If I knew that, I would be telling you. I'd be doing that myself. I mean, it's
unsolicited advice today. No one's getting sued.
There's no free meals ever in a market. You've got to do your own research. There are actively managed funds that claim that they beat the market. But when you do your analysis and due diligence on them, it isn't so. I can give an example where 80% of all managed funds are out in the first phase when we shortlist them. That's the process that we have. You can't look at every fund specifically and say, okay, this is what they do, this is the process, and then whether you agree or disagree with their process is completely different. But imagine doing the same for equities where you have 500, 600 different actively managed funds. You can't possibly do that. You need a little filtering that goes on, and there might be opportunities that we miss, but that's how it is. Going after all opportunities and advising people on things that you don't know what's in your project is not ideal. But yeah, I'd say try doing your own research on say equities, because now you can take a risk. If the market crashes, you still have another 40 years to work and make back that money. Or when you're 60, when the market crashes and you have 2 years to work. So that's what I'd say. I mean, do research, you do diligence, and you just might beat the market. One
Okay. Not on you. Any other questions? Okay. So what do you think are potentially useful things people should be considering at the beginning that you would like to have heard at the beginning in terms of certification, co-curricular, outside work, outside research, all those things?
I'd say try contacting as many lecturers as you can. Attend at least the first few weeks of every lecture every semester to gauge what or how the professor is. Then, if a professor seems interested in helping your students, always approach them, if not pester them, every weekend. And ask them if there's any opportunity in terms of research work, or if there are any certifications that you can take up. There's the mentor program that I did at uni as well. So if you have free time, you can do that as well. And then try your network, essentially. If you have relatives in Australia, they're a really good network to help you. With research work, try getting at least a research paper done, because everyone has a master's today. There's nothing that's going to differentiate you if you don't have a research paper on your CV. Anyone can get an 80, anyone can get an 85 in master's. I'm not saying it's easy, but anyone can, because there are 60,000 students that enroll almost every 2 years. So try to differentiate yourself, do things differently. CFA is a good entry into finance. It's not difficult, it's just fast. And if you're looking to get into equities or investment banking or quant per se, do the econometrics unit, you'll not regret it. You might regret it while doing it, but not after. Because I regret it when I took it, but after I got done with that, I did.
Thank you, guys. Sit down, my back is sore. All right, thanks, Calvin. So again, Calvin's going to be around for a little while, so if you want to have a quick chat, please feel free to do so at the end. I think those that are proactive get the outcomes that they want. And at the end of the day, I think that one of the best benefits of doing a master's degree is the network benefit. Anyone can buy a textbook for a course and learn the material independently. The reality is you come into a program like this because you want to create a network that you can leverage and rely upon in the future, and hopefully create friendships that are going to be beneficial to you. So I think that's something that you guys need to be mindful of. Please pop over and say hello, and try to sort of gauge what you can do a little bit differently. I know that the idea of a master's is perhaps daunting enough, but in modern times, I'll be frank in saying I don't know whether it's enough. And these things take time. Calvin and Rahul didn't write papers year one, but year two they both did, and then they both got into internships, and they've both done many placements since. And you even interned with, I remember in the Mulgrave startup as well. So you did a lot of different things over the journey that have kind of gotten you here. But they both have hero publications. You're almost guaranteeing yourself interviews with management consulting firms, top tier organisations by doing those sorts of things, because they're big differentiators. And grades are good. I'm not going to say don't try to get a good grade. Okay, so try to get a good grade, but the reality is there's a lot more to it than that. So thanks for that. For those of you that have an interest in superannuation generally, I'll distribute these slides as well as some of my own that will allow you to sort of review the sector and look at some opportunities within the sector. Certainly it is a worthwhile opportunity, burgeoning opportunity, lots of gainful employment potential here. So please scrutinise the material, have a conversation. Please feel free to pop over and have a chat with myself or with others, and we can talk more about how you can pursue opportunities within this category. All right, so the next segment probably flows on a little bit more naturally from what we were just talking about. Rahul, who's a former candidate in the program, has also interned extensively and is also actively involved in research programs here now as well, has taken it upon himself to talk to you guys about the global financial crisis, given his knowledge of that segment. It's worthwhile talking about the GFC in light of the institutions that we've talked about in the banking sector, because really much of what happened because of the activity or potential inactivity of certain financial institutions that were key to the securitization process that gave rise to the global financial crisis. So the banks, the conventional banks, played a very important role in the context of the GFC, both in terms of securitization and also in terms of, I guess, the financial contagion transfer that happened ex post. All right? So try to keep that early discussion, that précis that I offered, in mind when having listened to Rahul. So I'm just going to invite Rahul out now. If you could all welcome him, that'd be great.
Thanks, Michael. So today we're going to look at the global financial crisis, but this discussion is going to be centered on the US crisis mostly, because most of the other economies kind of followed the US model and also slipped into recession due to similar factors. Notably, Australia was a big exception because they went into the crisis in really good financial health, and they had a surplus budget and they had record low debt levels, as well as the Labour government. They managed the crisis really well, and they also affected certain capital injections, and so that helped Australia navigate the crisis pretty steadily. But the US didn't have that; didn't do so well. So yeah, the roots of the crisis can be traced back all the way to an earlier crisis. Indeed, the history of the US economy in the noughties is pretty much a history of bubbles. So before this bubble, we had a bubble back in 2001, which was the dot-com crash, which is when internet companies were basically overvalued, and eventually the market self-corrected and people lost millions and trillions. So following that, to prop the economy back into full employment, Alan Greenspan and the Federal Reserve in the US, they implemented record low interest rates so that people have free access to borrowings. But what basically happened is, for people who study accounting, PPE is property, plant, and equipment. So those are assets which actually help economy grow. But instead, a lot of money went into the housing and real estate market and related markets, like if you want to buy a television or something, just things to fill your house with. So a lot of money went into there instead of PPE because there's already a high existing surplus capacity in the US economy. And the Federal Reserve pretty much embraced it, and Greenspan and the president at that time, George Bush, embraced house ownership as part of the American dream, and they encouraged people to go out there and take advantage of the easy access to capital and get houses. So the US economy slowly became more reliant on the housing market, and right before the crisis in 2007, it made up 2/3 of the American GDP. So these mortgages eventually, to take advantage of the easy access to capital, what mortgagors started doing is focusing more on mortgage quantity rather than quality. So they stopped doing due diligence on the borrowers, and eventually it went to an extent where they gave mortgages and loans to people with no income, no jobs, no assets. So basically nothing to guarantee that they'll ever get the money back, and that was profitable for them in the short term because they had high transaction costs attached to it. And they also offered these borrowers variable interest rates. So what variable interest rates do is they are attached to the market interest rates, and since the interest rates are low at that point, these borrowers weren't paying as much. But then, as we would see, the interest rates increased, and then the borrowers started defaulting. So these loans, as these non-ideal loans, if you will, were called it's called subprime lending, and they were pretty much the root cause of the crisis. So the mortgagors obviously knew that these assets were risky, and they didn't want to keep the risk in their hands for too long, so they went to banks, and banks helped them divest this risk across the economy. So as Michael discussed, there's a process called securitization, where you package different assets into one single entity, and then you can issue shares in the entity, pretty much like you would in a normal business. So you start a separate business, offload all your assets to that entity, and you can offer shares on that. You can offer you can offer any type of liability as you would in a normal business. So you have different tranches, as you can see. So categorized from most senior to least senior. So seniority basically indicates when you will get paid if there is a default. So the most senior will get paid the first, and the least seniors gets paid last. So yeah, so that's essentially what they did. So these are called CDOs. These special purpose entities that they created were called CDOs. And these CDOs were either sold to investors who first did not do their due diligence on CDOs, because CDOs are complex. They have millions and millions of these mortgages inside them, and it's almost impossible to trace back each mortgage to the source and ensure that the credit quality is good. So they could pretty much pass this off with other actual healthy assets, and people probably not do enough due diligence, and it could go past just rated AAA. That's the highest rating you get from a rating agency. And then on top of that, CDOs require you to own the mortgage, but there's a thing called a synthetic CDO. So the easiest way of looking at a synthetic CDO without getting too much into the technicals is it's basically insurance on the CDO. But the best part is it doesn't require you to own the CDO in the first place. So you can bet that the CDO will default and take an insurance out on it without actually holding it. So at the heyday of the crisis, if you had a house, say, worth 15, 16 million in let's say it's a cozy residential property on the seashore, and it's worth only 15 million, and your mortgage is probably around that much, there'll be about $1 billion worth of bets riding on it in just synthetic CDOs. So that gives you a scale of how inflated value was and not pegged onto any actual real source of value. And what also happened is with securitization, one of the biggest benefits is that risk is it's divested across the economy. So different people buy parts of the special purpose entity, so the risks are shared among those various people. But what eventually happened is banks found that if they sell to each other, they can keep the prices high. So it was a kind of oligopoly of the CDO industry as well. So they just kept buying and selling to each other, even though they were kind of trepidatious about what might happen. They still kept the market inflated by selling to each other. So these things, this basically led to a highly inflated market in both the housing industry and the CDO industry. So the rating agencies are there they're not regulators, but they act as a watchdog to inform the market of what they think the credit rating of a particular agency or a particular organization is. But with CDOs, first, like I said, they're really complex instruments, and it's almost impossible to source each one back to the original holding entity, the original borrower, as well as after a while they just didn't bother doing it. And the really close connections between the banks and the rating agencies, the really close connections between the executives within those agencies as well. So which meant after a while, most of these CDOs were getting AAA ratings without any diligence. And what the market did is they thought these rating agencies were like Standard & Poor's, for example, they are big brand names, so why would they be wrong? So all these AA ratings are taken as face value, and all these securities are priced based on that AA rating. So basically, their credit risk was pretty much not even considered. And then the crash happens. So the start of the crash could be seen as early back in Q2 in 2006, when slowly your consumer loans started defaulting and eventually real estate loans as well. But the Bush government at that time, as well as the Federal Reserve, assured everybody it was an isolated event and the markets will self-correct. And eventually, when the effect started going into CDOs, it started affecting the banks as well. Until now, the banks had been able to hide the CDOs because CDOs are something known as off-balance sheet activities. So off-balance sheet items need not be recorded in a firm's balance sheet. They're often just in the notes. So if you're investing in a bank which has a huge amount of CDOs, you'll probably be able to see evidence of that only in the notes to the financial statement, not even as an actual line item in the financial statement. As well as Basel I did not have any capital adequacy requirements. So if you invested in your company had a CDO, you would not, that particular company need not have capital set aside for that particular default. So if that defaulted, you could basically go to the bank and they'll have no money left because they've invested in the CDO, which you had no idea about. So a lot of this happened, and the banks finally started seeing losses, and they realized that their CDOs were toxic. And that could be seen because in August 2007, the spread between the interbank rate and the T-bills spiked. So what that basically means is, in a good economy, the interbank rate and the T-bill rates will be almost equivalent because it shows that the banks trust each other as much as they trust the government. But the fact that the spread increased shows that there was obviously uncertainty in banks lending to each other. They knew that their own assets were toxic, so they didn't trust each other's assets. So they were not sure who to trust. It's a problem known as adverse selection. So they just stopped lending to each other, and the credit markets pretty much just dried up. And by December 2007, the US economy had slipped into recession, and this showed that it was almost impossible to deny that it was having effects. And then Bear Stearns, one of the biggest banking and investment organizations in the US, was back in 2007, their share was trading at about $100 a share, and they were bought over for just $2 a share by the start of 2008. And by September 2008, two pseudo-government, well, not pseudo-government, but Fannie Mae and Freddie Mac, which partially had government interests in them as well, also had to be bailed out. These were entities that created CDOs. They basically packaged mortgages into CDOs and sold them on to banks. So they had to be bailed out when these CDOs defaulted. And then finally, in 15 September, one of the biggest events of the crisis happened. That's when Lehman Brothers was allowed to crash by the Federal Reserve and not bailed out. That's basically because the banks decided that they would not. The banks and the Fed decided that they would not bail Lehman out because they had problems with their own. And Lehman was on their own record amounts of leverage. Richard Folder, who was the CEO of Lehman at that point, had taken the bank up to 20 times the assets under management in leverage, which is basically they borrowed 20 times as much. So when they failed, it was pretty much the effects were felt across the US economy because they were not going to pay back their borrowings. And eventually, after that, a lot of other banks were bailed out. Most notably, AIG was bailed out for more than $1 billion. And there was this Hank Paulson, who was head of the Fed, petitioned US Congress for a $700 billion bailout package. That was later revised downwards because this $700 billion is based on the US government basically buying the toxic assets from the banks. But eventually they realized they weren't getting much for the toxic assets. They were getting 20 cents on the dollar, which is abysmally low. So eventually this package was revised down to about $240 billion, But yeah, it's still one of the biggest. I think it's the biggest bailout in world history. And the effects of the crash are felt pretty much across the world. Spain has had its own housing bubble at that point, and they collapsed as well. They had better debt levels than the US, but the economy is much smaller. So the effects are felt pretty much immediately. Throughout Europe, mostly unemployment rose. Greece fell into its own crisis and pretty much kick-started the Eurozone crisis after that. And levels of interest rates, levels of employment have recovered since then, but are still being felt. The effects are still being felt around the world. So yeah, so that's the financial crisis. Questions? Yeah.
Mentioned that eventually the shares fell to $2 a share.
Yeah.
Right?
Yeah.
What were they at prior to? What were they at before they fell?
The quarter prior to that, the start of the quarter prior to that, they were $130 a share. Yeah, but that $2 figure was revised back to $10 after they went through a legal listing as well. So they were revised up to $10, but that's still 13 times lesser than $130. So yeah. They lost 13 times the value. Yeah.
$128.
Yeah. Pretty much.
You think the banks will recover?
Well, they have recovered. The US government helped them recover, didn't they? So that was again not a big problem because the banks knew they were too big. The four pillars that Michael mentioned before are to prevent big banks from merging with each other and causing this thing called too big to fail. That's when banks know they're so big and they have so many depositors and so many dependents and so many externalities that if they fail, the economy pretty much collapses. Like if Lehman failed, then the economy collapsed. So these banks are sure that they're too big. Like the government is not going to allow them to fail, and they'll be bailed out whatever the risk they take and whatever happens. So, and that came to be. No bankers were ever jailed in the US. They were in Iceland, but not in the US. And pretty much all of them got away scot-free. So yeah. Yeah, it could happen again. They already, so now US banks are taking advantage of the new millennial generation not having savings and the fact that we can't find full-time jobs. So they're offering us housing loans because we can't afford houses on our current salaries. And these do not require jobs, these do not require assets. They're back to just ninja loans. That's what they essentially are, but they are just called other things now. So.
But this is not in Australia, though.
Yeah, not in Australia, though. They say, so Basel II was reaction to this. So they say the capital adequacy is enforced by Basel II and then by Basel III. Not everyone's ratified Basel III yet, but they say that this is sufficient, that the capital adequacy standards that Michael went through for all the different types of risk and the off-balance sheet risk, the capital adequacy that they would take now for off-balance sheet activities. They say that that's enough, but there's no actual evidence of that, and yeah. Well, we do not know until there's a credit event. So, yeah.
That's really good. George, over here, thank you. Roll. Okay, so that was kind of enlightening. For those of you that, as I said, have an interest in these subject areas, the guys are going to be involved with the unit this trimester, and I'll certainly circulate this material as well, and there'll be ample time to have a chat about it over the course of the semester. So, with that said, we do have a little bit more to cover off on before we can call it a day, and we'll do that now. All right, so this next set of slides is a reasonably short summary of the other categories of institution within the system. We've already talked about managed funds and super, so I'm not going to dwell too much on those, but I dare say there probably is some worth in talking about the others, albeit briefly. Please also review these in your own time, bearing in mind that this second segment is perhaps of less significance than the first segment in the context of your final paper. Okay? So let me just launch this. All right, so just a quick summary or précis of each of the other categories of institution. You probably already know this reasonably well. It's probably something that you're fairly familiar with, but if you're not, this should serve as ample preparation. All right? So these are the categories of institution we're going to talk about. As I said, in Australia we make reference to money market corporations rather than investment bank or merchant bank, but I'm using the popular terminology. We're also going to talk briefly about life insurance offices, general insurers, super funds, albeit briefly, finance companies, permanent building societies, credit cooperatives, managed funds, and export finance corporations. Noting that permanent building societies, credit corporation, cooperatives, and export finance corporations are of little modern relevance. Okay? So we'll start by talking about merchant banks and investment banks. They've grown perhaps in terms of their transactional importance, but in terms of transaction size. Regionally, certainly they've not grown in terms of asset pool size. This is in part because of the expansion of other categories of institution. So in particular, the expansion of super funds has sort of encroached upon their overall size. So they have grown, but they've only grown in absolute terms. They've not grown in relative terms. Okay, so why are they important? Why do we devote time to them? Well, for many of you, this is why you get into finance. Many people actively pursue opportunities in this category. Rest assured, it is an exciting space to work in. I have quite an interest in venture capital and emerging markets opportunities, quite an interest in investment banking generally, albeit more from a venture capital or Series A type side. But I sort of want you guys to appreciate that the reality is there's a number of sort of exciting opportunities within this space, but there are many more beyond them. Okay, so it's not the only category of institution that you should be putting applications out to. All right, so what would you do if you were to work in the context of an investment bank or merchant bank? Well, you're going to be working largely in transaction services or corporate finance transaction structuring. So essentially, you will work within a pool of other associates because you'd be applying at associate level, given that you're graduate students, and you would be working on supporting or providing general support, transactional support to a number of transaction opportunities. For argument's sake, you might be putting together pitch documents, briefing documents, valuations. You'll certainly be spending a lot of time working with mathematical and statistical tools, certainly spending a lot of time in Excel. Just putting a lot of transaction structuring together. Australian investment banks are demarcated by a rather unique model that is increasingly popular around the world. Our investment banks, in particular the larger investment banks in this country, tend to take a very unique approach to transaction structuring, and it's very driven by infrastructure assets. All right, so if you look at major investment banks, Pemberton Brown, Wiley & Co., Caliburn, Macquarie Bank, they love infrastructure assets, global infrastructure assets. Why do you think our investment banks, and increasingly investment banks generally, have such a love for infrastructure assets? Like tollways, airports?
Because they produce revenue in the form of...
That's exactly right. They produce a lot of good, consistent, recurrent income. They're boring assets, okay? Boring assets generally produce a lot of recurrent revenue.
Can I give you an example? Let's say you go on to a private road. Costs $3. You haven't got a little thing to
E-ticket.
e-take. Yeah, okay. You go away from that and you choose to ignore it.
Mm-hmm.
It's in your bill. It's in two bills. One for $15, next one goes to $27. You don't pay that last one. Keep them ticking over. So at the end of 1 year, you can end up owing $57,000.
Yeah.
That's how they make their money.
That's not yeah, penalties are a portion of their income, but yeah, look, they just make income because people use infrastructure assets a lot. Airports have a high utilisation rate. Roads just have high utilisation rates. So the reality is they're popular categories of assets to pull together. What's the other great thing about pooling infrastructure assets? That's exactly, the fundamentals of infrastructure assets are absolutely fantastic. So they're very saleable. All right, you can assign those assets, a really good answer, you can assign those assets very, very comfortably to many different institutional categories. Super funds will love them, managed funds will love them, general retail investors will love them, because there's something that underlies them that is easily understood and very, very tangible. But the best thing about it is you can structure it in such a way that you can get 3 revenue streams. All right, think of Macquarie Infrastructure Group. Okay, Macquarie Infrastructure Group carries a huge number of airport and tollway assets. Pulls them all together, they generate revenue. They then assign units to other parties, but they carry a portion themselves. So they choose to own a portion of that pool of infrastructure assets. Okay? In addition, they serve as trustee to the vehicle. All right? So they get to generate trustee revenue from the management of the infrastructure assets. Beyond that, they have a super talented pool of investment consultants. So they provide direct advisory service to their own infrastructure assets, which is also expensed out. They get 3 sources of revenue from one asset collection. Kind of a brilliant model. Macquarie Bank, year on year between 2005 and 2008, okay, I should say 2007, we'll keep it conservative. 2005, 2006 grew at over 125% year on year, as did the majority of firms in that category. So our investment banks, while not substantial in number, have been incredible in terms of revenue generation. They've really been leading the way in a number of categories. That is not to say that they're the only ones doing this, but they have actively championed this. Some of the largest tollways in the world and the largest collections of airport and port-related infrastructure assets are owned by Australian investment banks. Okay, so that's one of the unique qualities of Australian investment banking: a strong focus on infrastructure and a strong focus on very defensible and creative revenue generation. Owning the asset, managing the asset, and consulting to the asset. Okay. They're also actively involved in these categories of enterprise. I'll concede in Australia, venture capital is more of a concept than a reality for many of us. I started working in venture capital many, many years ago, and many of the firms that I worked with had such a low risk tolerance that you would spend all your time pitching things and there'd be varied or limited consummation. But that is changing. More and more venture money is flowing into our system, and there are increasingly exciting opportunities for you guys, whereby you will work with venture capital firms and funding bodies, AOFC type bodies, and early stage venture capital limited partnerships, ESVLPs, and you'll actually get to do some remarkably exciting work, stuff that I would have dreamt of doing when, in the earliest days of our venture capital segment. Our government is actively incentivising this category. In the last 2 years, you've probably heard about this in your other courses in accounting and so forth, but in the last 2 years we've actively revised all of our laws in relation to early stage limited venture partnerships. We're actively encouraging people to put money into this segment by providing them with dramatic and substantial tax deductibility, as well as strong incentives to pool money, whereby the government actually matches pooled money as well. All right, so we're actively pushing this category. Really exciting segment to work for. You're all eligible. Why not contact some of these firms and ask them if they want interns? And if you want some ins, you can email me and I can pass on some details as well. All right. Very, very briefly, we're going to talk about life insurance companies and general insurance companies. Why is it worth talking about them? Well, they are an interesting segment. They warrant our attention. For those of you that have an interest, I'm more than happy to connect you with brokers. Again, one of these spheres I think that people don't pursue, I'll be frank, because they think it's kind of boring, right? Is that why? You guys have probably never applied to an insurance company, even though I told you I knew senior brokers. Neither of you has ever emailed me about insurance. Why is that?
It's insurance.
Yeah, I know, but this is the thing. If everyone has that attitude, the whole segment gets very few applicants. And not all the work is boring. If you're leading an insurance brokerage, you're doing some reasonably exciting work. You're analysing business models, you're assessing underlying risk, quantifying it in the same way that you would at a bank, and you're then contacting Lloyd's of London and getting an insurance contract put together. That's pretty cool in terms of your day-to-day. All right? this segment, I think, is one that you should all be pursuing more opportunity in. I'll concede, frankly, that life insurance is perhaps a little bit less exciting to graduates, but it shouldn't be, because it's a very important category. Okay, the provision of life insurance is a really honourable thing. It supports people's day-to-day life. How does life insurance work? Because they need quants, they need talented people like yourselves. How does life insurance work? How are contracts put together? Okay, well, I have a number of insurances in place. I often joke about this. I probably shouldn't joke about this with my kids, but I often joke about the fact that I'm really heavily insured. So if something happens to me, they're effectively looked after. But I shouldn't. It's probably a terrible joke. But in saying that, it explains the notion of insurance. What is insurance? How does insurance actually work? Well, insurance officers try to quantify the likelihood of given occurrences. So I have a number of insurances privately and also through Deakin that has sort of insured me for the work that I do, in addition to insurances that come with my super fund. Okay, so I probably have more coverage than I need. Each insurer assesses the likelihood of a given event in the context of my life. And I often like to look at policies of this type to sort of analyse how they go about assigning risk. And having worked in quant teams before, it's kind of interesting. They look at the likelihood, for example, of a given event, like the likelihood of you injuring your arm and perhaps losing a finger. They look at the likelihood of you losing your thumb, for argument's sake, the likelihood of the loss of a key limb. And they look at the potential impact of that loss on your life and your ability to generate subsequent income in the context of a permanent, a temporary or permanent disablement policy. Okay? A TPD policy. Temporary or total permanent disablement policy, which would be a TTP policy. Once they've quantified that likelihood, they actually assign the likely costs attaching to it to that likelihood, and they average that out over an entire category of individuals. The benefit, the loss benefit that you received, is a function of the likely impact of that event on your life. So for argument's sake, if I was to lose my little toe, I believe that the policy says that the payout value is around $10,000. But if I was to lose my thumb, the payout value is between $40,000 and $70,000. Why is that? No, but I'm going to get less money if I lose my toe. I'm going to get more money. It sounds like a lottery. But you get where I'm coming from. If I lose my toe, I receive less money for compensation than I would if I lose my thumb. Why? Because this opposable thumb is very, very important, okay, in the context of your day-to-day life and the work that you do. So that's how policies work in reality. It might sound rather odd, but that's in essence what is being quantified. The likelihood of a given event, the cost attaching to that event is categorised and grouped across a category of individuals, assessing the likelihood of that event. The likelihood of me losing a thumb is very, very low, so the premium that attaches to that, the cost that attaches to that for me is very low. If I was in the construction industry, the cost of insuring me would be far, far greater. Okay, so they quantify the likelihood as well. Who is the person within the firm that does this? Who does this within an insurance company? This is an unfair question for them, so I'm looking at you. Exactly, the actuaries. And you guys can be the actuaries. You guys can learn in actuarial sciences if you want to. And do you know why you should? Because so few people do. And it's actually kind of interesting, and you're all incredibly capable. If you have the sufficient numeracy to do this, it's an interesting area to be pursuing opportunity within. Again, everyone's relative asset pool has diminished in recent years and will continue to diminish because of superannuation. So don't read too much into those figures. When you see the updated figures in my textbook again, don't read too much into them. Okay? The only reason that the relative base is diminishing is because super is growing so quickly. Okay? It's still a very important category. These are some examples of policies: whole of life, term life, total and permanent disablement. They can also be temporary disablement policies that are combined with total and permanent disablement policies. We then have trauma policies, income protection, and business overhead. Income protection has been pushed very, very heavily in this country at the moment. You probably note this as you watch mainstream television, okay? Because it's a relatively straightforward policy to insure for, and moral hazard ensures that we actively try not lose employment because we don't get full cover. Most Income protection policies only cover up to 70% of your income, meaning that there is no real potential for a moral hazard likelihood or a moral hazard claim because we don't want to lose out on income. All right. What about general insurance? I've worked with a number of the top brass from AIG and other organisations, particularly around the time of a couple of major weather events that have impacted general insurance. Is general insurance and the asset pool of a general insurer more consistent, more staid and more stable than the asset pool of a life insurer? Who would invest more heavily in short-term assets? A life insurer or a general insurer? Will invest.
More a better run because the general insurance, I guess the last 10 years has been hit by more
Unanticipated events.
calamities.
Yes.
Whereas the life insurance, it's always the same as
Yeah, so anyone have any thoughts? Life versus general? I think that's a good summary. I think, in essence, general insurance events are far less predictable. You can't predict general insurance events. As a consequence, general insurers, their lives are much harder. Why? Because they have to invest far more short to medium term. Life insurers can invest more medium to long term. All right? So there's much more contestation in general insurance, and it's a much tougher gig. Because you're managing shorter term assets, you're having to ensure greater liquidity within your enterprise. All right? Those of you that are interested in interning in insurance, if you are happy to explore it, as I said, I know a number of individuals that run major insurance groups. More than happy to connect you after we've got to know each other a little bit, and I'm sure that you're not going to embarrass me. Okay? No, I'm being facetious. If you would like to be connected with them, more than happy to assist. All right. Super, we've already talked about. Calvin did a wonderful job, so you can read that in your own time, but it's not dissimilar to what was just covered. We'll talk briefly about finance company and general financiers. I'm going to keep this discussion very, very simple. They operate in a very similar way to banks, but there is a critical point of divergence. How do they differ from banks? In one critical way. That's exactly right. They cannot lawfully accept deposits from the general public. Thank you. Finance companies can only issue instruments, marketable securities, into the market to secure the money that they need to make good on the products that they offer. Okay? They cannot lawfully accept deposits from the general public as finance companies. Okay? So I've worked with, I used to work in treasury operations at Ford, and obviously we've got a lot of dealings with Ford Credit. Okay? They're a good example of a vendor financier. I used to also do some consulting with, what's the name of the group at that time? Cat Financial. Ever seen those big pieces of earth-moving equipment? It's very rare that those pieces of equipment are purchased outright. They're almost always purchased under a finance agreement. All right? And a vendor financier will work with the company that sells them to try to market those products. The finance company industry is a big one in this country. One of the key reasons is that within Australia, if you invest in a security that has a value of greater than $50,000, what is the assumption that the market makes about you? Well, you're assumed to be an informed and astute investor at that investor level, which I think is a rather odd piece of policy. It's a rather odd law that we have. But at that level of investment, there is no requirement for a full prospectus. Okay? There is only a requirement for an information memorandum. So our laws assume that once you hit a particular investment tier, you are smart enough to figure it out. I've wanted those laws to change for a very, very long time because there are many people that have substantial wealth by virtue of working a very hard amount over a course of an incredibly long time, that accrue that amount of wealth, that are put in a position to lose it because of these laws. And our finance industry has been tarnished quite badly in recent years because of the manner with which a number of poorer players within this segment have operated. They've exploited mum and dad investors at the expense of the industry. Okay? It is something that is being looked at and the laws are being revised, but equally, I guess in recent times we've learned some rather unfortunate things about those even affiliated with the banks. Yeah, I dare say though, those affiliated with the banks traditionally have been better performed than some of these unaffiliated players. That is something that we'll talk about in a few weeks' time as well. All right. Permanent building societies. Do you guys have any familiarity with this category? This category of institution exists almost everywhere in the world. I should say everywhere when I say everywhere in the world. Anywhere that has adopted an Anglo-American model of law would normally have allowed for this category of institution. This is essentially an institution that was enacted or created with the view to facilitate greater participation within the property sector. So in the UK, in the US, and a number of other OECD countries, they have an equivalent institution that actively drives investment and participation within the property segment. This category of institution was incredibly important for a very, very long time because there were a substantial number of institutions falling into this category. In the 80s and 90s and early 2000s, we actually saw substantial participation in this segment. Okay? It was as high as 3%, which mightn't sound like much, but it's a huge amount when you think about the total market. All right? Why do we not see as many in this category any longer? Quite simply because the majority of them have become banks. The majority have chosen to take on a banking license and are now banks. We in Australia, we at Deakin actually work with Bendigo Bank. We have the first university-based bank called University Bank, based out of the university here. And you can actually intern with them if you want, apply to them, why not? You know, there's a lot of great opportunity to work in banking on campus as an intern and learn a little bit more about how mortgage lending works. With that said, the segment itself, as I said, has evolved markedly. Only a handful of institutions exist in this category. They do everything that a bank does. However, they tend to take a more conservative approach to lending. They operate generally what is best described as a mutual style model. What typifies or defines a mutual style model, generally? They tend to only lend to the extent of what they have. They don't engage in the dynamic lending that a bank does. They don't go into the market, issuing additional securities, pursuing dynamic opportunities for finance to make more loans. They tend to support or align themselves with a particular category of investors as well. Okay. What about credit cooperatives? Credit cooperatives are not that different to building societies, however their initial orientation is a bit different. As the name would suggest, building societies are orientated around building and construction, new housing in particular. Credit cooperatives provide a much broader pool of service offerings, and they tend to almost always be aligned to a particular category of employment. So in Australia, and in Victoria in particular, there is a very strong teachers' credit union. Okay? They provide loans in particular to teachers. How do they differ from banks? Well, again, not markedly, albeit they do engage in less dynamic lending as well. They have been largely stable in terms of asset share. They are still kind of relevant. In Australia, unlike many other countries, we don't have a small lender institutional category. In the US, they have a further category known as the thrift institution category. Okay? In Australia, the closest analogue or equivalent to that missing category, thrift institution category, is the pawnbroking category, or some would describe it as the payday lender category. It's a category of institution that provides short-term finance at ultra-high rates of interest. All right? So we don't have that segment. It is the missing segment, all right? If you were to compare the US model with our own, you'd come to discover just how substantial that thrift segment is there. We are seeing an increase in the amount of payday lending. It's something that I want you guys to be particularly mindful of and careful of. Payday lenders are allowed to charge as interest up to 47.5%, okay? And they generally all do except for the ethical ones, like Good Shepherd. Okay, Good Shepherd's a very ethical organisation offering a lower cost arrangement. The vast majority of others that participate in this segment can charge up to 47.5%. Okay, I'm not going to dwell on managed funds too much because your summary of superannuation is a good introduction to the managed funds industry anyway. What I am going to do is introduce you to some terminology that diverges, just so you're aware of how the terms are used interchangeably, some of the differences that do exist. So we in Australia use the expression managed fund quite frequently when we describe this category of institution. You'll find that in the US, the expression mutual fund is used quite frequently for a similar institutional category. Let's be clear, the laws do differ slightly. Okay? The responsible entity, special purpose entity laws in Australia in relation to managed vehicles like this do differ somewhat from the mutual funds laws of North America, but they are similar enough for them to be considered the same category. The same is true of the expression trust fund. We use the term trust fund when we're making reference to a very technical definition, okay? But more often than not, managed fund and trust fund are used interchangeably by academics and by those in industry. Technically speaking, the only set of terms that has a formal definition in Australia is the trust fund definition. Okay, but we generally describe most trust funds as being managed funds. So a managed fund established under a trust deed managed by a trustee or responsible entity is referred to as a trust fund. Right. It's an important segment. I'm just going to skirt over all of that to this slide because I think this is arguably the most interesting slide because it speaks to the public unit trust category, which is a relatively small segment of the managed fund industry. But as we unpack this slide, we will note property trusts make up 37%. We in Australia, we love property and we love equity. What do we not love, quite clearly? Again, this is a further example of the investment appetite of Australians. You would look at this slide in North America, the United Kingdom, it would look remarkably different. We invest more in equity and property than we do in any other category. Look at the mortgage trust segment, 3%. Rahul's entire discussion was of that segment. Okay? In our market, it's only 3% of 19%. It's a tiny segment. Why do you think we have such a limited appetite for securitized assets here? Maybe we're just smarter than the rest of the world. We saw all of the risks and we chose not to invest. I think it's just because we love the returns in the equity market. We always think that equity is going to return more, and we love the returns in property. But when I do seminars with people abroad, I tell them it's because we have the most astute investors in the world, and we understand risk pricing, right? I do a lot of training for the CBA team in China, and that's what I tell them as a joke to start with. Yep. That's an excellent point. I mean, it really depends on the view that you want to take to it, and I agree with you wholeheartedly. Simple debt instruments are vastly simpler to understand than the commercial models of various organisations that we can invest in the equity of. Undeniably, that's an excellent point. But when it gets to more complex securitized assets and asset pass-through and risk pass-through, I actually think debt becomes far more sophisticated. Just because of the sheer number of instruments that can be generated from one pool of assets, understanding the underlying risk, how the pricing and risk assignment works, I think is more complex. But I guess it's a case-to-case thing. But again, just a really critical point that's sort of worth noting. Even though there is a substantial amount of risk that comes with securitized assets, risk also comes with equity. And equally, as Australians, we still haven't really become hugely enamoured with securitization. Even though almost every other market in the world loves investing in pooled assets, we haven't really developed an appetite for it yet. But that could change. And I don't want you guys to think securitization is bad. Misrepresenting what a securitized asset is very bad. But the process itself is not bad. It actually presents people with great investment opportunities and improved yield opportunity. And I think some of the best innovators in the fintech space are going to be innovating in this category, making securitized assets more available to mainstream investors. Okay? Well, that is the extent of what I wanted to talk to you guys about today. There are a few more slides that you can peruse in your own time, 3.9 and 3.10. As I said, there isn't a great deal to talk about in the context of 3.9, but we'll do that briefly next week, and you can peruse it yourself. What I am going to do, as I said this evening, is release your assignment and the question set for the remainder of the semester. We normally don't cover any questions the first couple of weeks, but from next week onward, we're going to be covering each question set on a 1-week lag. So in the coming week, we're going to be covering this lecture and the preceding week. We're going to be following it up with a 1-week lag for every question set thereafter. All right? The solutions will also be made available online. If at all possible, if you could come prepared in advance of that section, that would be great. Also, please bear in mind the textbook is available. You can print it online. To access the lectures, one more second. To access the lectures, you can use any QR code. All right, so you can scan the QR codes in the textbook with any QR code scanner. Just need to make sure you set up an account first. I provided you with a free PIN that allows you to do that. Okay, please make sure you don't enter it in any financial information. Just use that PIN to access the material freely. Okay, the instructions are on the front page of Cloud Deacon. All right, I shall see all of you guys next week. Have a lovely week. Hard to find if you just have that information. BCC. 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 Burwood Corporate Centre. All good. Yeah. No problem. All right, so I'll be there all day. Level 2. Yes, you remember, so when we were standing together, the one right up the front, you go up the steps, up one level. All right. No, it's all open, you'll see me. Yep. Yeah, right in front of the right in front of the Burwood Corporate Centre. Yeah, cool, I'll see you then. Anytime. All right? Except between 3:30 and 4:30, because I have to, they're giving me a new computer and new server and stuff, so yeah, outside of that time. Yeah. You have my email? So you just email me and I'll get back to you, yeah? You can't find the last email. And it's not really... Good. See ya. Sorry? What's happening? So, like first and second. Yeah, pretty much like the first and second. Yeah, yeah. Next lecture is interest rates, so I think that will be chapter 10 and chapter 13, but I'll put it on the cloud. Yes, I'm putting a readings planner up there for you guys, so memory 10 and 13. Yeah. See you.
about the internship, right? Like prior to this, I have experience in global security operations in BNP Paribas.
Oh, cool.
So,
Great.
like, how far will the experience be considered?
Oh, I think it'll be considered a lot.
Oh,
Yeah. I'm just going to shut down because I'm sure there's a group coming in next, and we can have a chat outside. But no, I think it'll count for a lot. That's really good. Good comparable experience. What
like it's just for 1 year experience. That's all.
Yeah?
I have. Like,
In-
I have done my PG already.
Okay. In finance as well?
Yeah.
Oh, okay. What are you doing this for then?
This is like myself. I was not satisfied with my PG in India.
Oh, okay.
That was
Fair enough. Well, a lot of this is going to be rather repetitive for you, but yeah, I think that'll count for a great deal. It's a well-regarded firm here.
okay.
It's a very well-regarded firm here.
Okay.
Yeah, I have many colleagues at the local
It provides
BNP.
only the internship or some part-time work or something.
Sorry?
Like, it provides only the internship.
It really depends on how well you can market yourself.
Okay.
You know, so I mean that comes down to the individual. Once you put yourself in a position to be considered, then it's down to you as to how well you can kind of market those.
Okay.
That makes sense.
Yeah. Like as far as I saw, like many of the companies are providing only full-time work. Like as of now, student, I can work only for 20 hours a week. So that's the reason.
Yeah. You are correct, but that doesn't mean that you can't. So a lot of my students do. You put the effort and you'll get something. It's just about starting early, and trying to put as many applications. There are a few opportunities to work in the university. Yeah, there are a few. Depends on what you want to do, but yeah, it's quite varied. Yeah. I'm terribly sorry. I will endeavour to use simpler. No, look, I understand. I hope it gets easier for you. No problem.
Also, a subscription level.